The bond market has something to say, and equity investors are finally listening. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off the closing bell here in the U.S. to take a look at where U.S. equity markets are right now, and they're lower. The S&P 500 lower by about 0.2%, not too much. Big tech not faring much better. You can see the NASDAQ 100 off by about 0.4%. And that's the case even though we're actually starting to see yields fall. Again, had to double check this, but you are seeing a bit of a bid come into the Treasury space. You look at 10-year Treasury yields right now about 1 to 2 basis points lower. So again, not anything huge, but definitely notable after the huge sell-off that we've seen. And the VIX starting to wake up as well. We actually had a 19 handle earlier in the day, Romaine. Come back a little bit, but still the VIX has been on the rise as well. Yeah, the VIX on the rise here. And of course, Treasury yields, I guess a little bit of a mixed bag here on the day, but that still remains the big story, and no shortage of opinions out there about the historic velocity that we've been seeing in Treasury market repricing, which of course feeds into equity market repricing as well. JP Morgan Asset Management's Kelsey Barrow was on Bloomberg earlier. She says it's time to face the reality that the sell-off in stocks and bonds is because there is a very real important tightening of credit, and she says this is exactly what the Fed wants.
I really do think that this stems from the September FOMC meeting and the dot plot. Sure, they still showed cuts next year, but what they showed is a real policy rate that actually goes up by 50 basis points next year. That is a very hawkish message, and the market is still trying to digest that right now.
And digesting that message also means coming to terms with the possibility that the Treasury portion of the cross-asset sell-off, particularly on the long end of the yield curve, is a signal that the market foundations are less solid than everyone thinks. At least that's what Peter Scheer said, head of macro strategy over at Academy Securities. He said that the risk-off mood in the Treasury market, and essentially is what is supposed to be a risk-free space, cause for concern. Take a listen.
For the first time in my lifetime, people are actually questioning the trajectory of where treasuries are going to be, and that is very concerning to me because every financial bubble that we've ever had has always come when it's a safe asset that breaks. It's never the risky assets, it's when a safe asset breaks, and we had a whiff of that in the past kind of week or two.
And you don't need to tell that to Bill Egan. He runs the $8.8 billion JP Morgan Strategic Income Opportunities Fund. And he's steering clear of long duration, Katie, keeping most of his assets right now in commercial paper and other cash-like instruments. The rest of the portfolio is actually going into short-dated, floating-rate investment-grade debt, which, of course, actually would benefit, believe it or not, if yields continue to climb. And that's exactly what it's been doing. Of course, we're seeing yields come back a little bit today, but that is very much not the trend. You take a look at the 10-year yield, you take a look at the 30-year yield, and the direction has been really straight up over the past couple months, a trend that really started, as you can see, in about 2020, 2021. And even again, with this little bit of a pullback that we're seeing, we're talking about cycle highs. You have to go back 15 years or so to see yields at these levels. And of course, as yields go up, prices go down. And when we think about the drawdown that we've seen at a broad benchmark level, we're at historic proportions, a 46% meltdown in that bond index. Romaine, on a lot of different levels, that rivals what we saw in the dot-com burst. You're seeing it in the bond market right now. Absolutely. Let's get some insights. Excuse me, I'm a little verklempt, Katie. This is a lot going on today. I have a feeling we're going to get 3 hours of real yield. Subadra Rajappa joining us right now, Societe Generale's head of U.S. rate strategy. And Subadra, actually, let's start on real yields here. I mean, we've been talking about them so far in this program on a nominal basis, but it seems like when you factor in inflation or factor it out here, that seems to be the real concern, at least for equity investors.
Absolutely. I think we've seen a very precipitous rise in real yields. I would argue that a good portion of the rise in nominal bond yields has come from the rise in real yields because inflation expectations have remained largely within a tight range. 10-year break-evens have stayed between 225 and 250, so inflation expectations are relatively range-bound. And the rise in yields has been pretty much because of the rise in real yields, as well as the tremendous repricing rising of term premia. Term premia has risen, quite dramatically in the last few months because of a variety of considerations. So, that's kind of what we're watching to see if there's perhaps more room for term premiums to reprice higher as we digest the supply over the next 6 to 8 months.
When you look at the price action we've seen in the Treasury space, I mean, the volume, of course, as well as the volatility is what I'm trying to say here, Subadra. And you look at the volatility that we've seen here, is that indicative, though, still of a market that is relatively orderly, or has something really fundamentally broken?
So that's a very good question. I think that the move higher in yields over the last couple of weeks at least feels a little bit more technical than fundamental to me. We haven't really gotten much by way of new data that would justify, 50 basis points higher in 10-year yields in a very short amount of time. The data, generally speaking, has been resilient. We get an employment report tomorrow, which again should show some level of strength. But again, that doesn't justify a 50 basis point rise in yields. There has been, however, a bunch of technical factors that are pushing yields higher. I mean, unwinding of short positions, unwinding of perhaps volatility positions, hedges that people are putting into place. And then with bond yields getting to historic highs, as Katie was pointing out earlier, you're starting to see some hedging in some of these futures contracts as well that are pushing yields higher.
And even if it's technical in nature, the reason that we're seeing long-end yields really take off there, tell us about what that means for the Fed's policy goals, because actually we heard from San Francisco Fed President Mary Daly just a little while ago speaking with Bloomberg TV's Lisa Abramowitz saying that if yields remain high, there's no need for another hike, that this recent bond market tightening is equal to about one rate hike. When you think about what we're seeing, especially on the real yield side, how does that translate into monetary policy?
That's a really good question. And if you go back and sort of look into the discussions we've had over the last year, Katie, I think myself and others have discussed the fact that the monetary transmission mechanism is broken because of the fact that front-end yields have risen quite dramatically and you're not seeing that impact into the broader markets. Now you're starting to see back-end yields rise quite meaningfully, and that it tends to have a much more meaningful impact on mortgage rates, corporate borrowing rates, as well as the strengthening of the dollar that's going to have an impact on emerging markets. It's going to have an impact on equity valuations. So, in some respects, I think, your comment and your question is spot on, because the rise in long-end yields, in my view, has a much more meaningful impact on the broader economy than just the Fed raising rates in the front end, given the fact that the market dynamics, especially given the pandemic period where mortgage holders had locked in these 30-year mortgage rates, you really haven't seen the transmission of tighter monetary policy into the broader economy, but now you're starting to see that.
So maybe a silver lining for the Fed, though, but what would really definitively stop this bond sell-off? You've seen some theories out there. This note from Barclays made the round saying that basically if we saw risk assets fall sharply, maybe we'd start to see some of that haven bid come back into treasuries. When you think about the magnitude of the move that we've seen, what would really firmly arrest it at this point?
Again, this is a very, very tricky situation. Clearly, if yields continue to rise, you're going to see that feed through to a variety of metrics. I think consumer sentiment is going to come under pressure. You're already seeing default rates start to rise, delinquency rates start to rise. The consumers are starting to pay up their student loans. So you are going to see this impact of higher interest rates being broadly felt by the economy. It's hard to know what that clearing level is. Is that 5% in 10-year yields when things start to break, and you see this sort of feedback mechanism into risky assets and tightening of financial conditions that would lead to perhaps investors coming back to the safety of bonds? Or is it 5.25 or 5.5%? And that's really where I think the call gets a little bit tricky. In our view, I feel like 10-year yields have already risen quite dramatically. We could get to perhaps 5%, but I think if we stay at those levels, you're going to see that pain in the broader economy.
Subadra, always wonderful to talk to you. Great insights as always. Subadra Rajappa over at SocGen helping us to kick off today's program, kicking you off to the close. In just a bit, we're going to hear from my interview that I had a little bit earlier with the New York State Comptroller, Tom DiNapoli. We're going to get his insights on the state's pensions fund investments and how he navigates the role of ESG.
Plus, who will replace Kevin McCarthy as House Speaker? And can a government shutdown be averted next month? We'll talk about it with Kim Wallace of 22V Research.
And, of course, ahead of a big jobs report tomorrow, we're going to hear from Chatterji over at Duke University to get his insights on the manufacturing job sector and the future of chip making in the U.S. All that and more coming up in just a bit. This is Bloomberg. Welcome back to The Close. For more than a year now, the inverted yield curve has been closely watched by investors as a potential signal of a coming recession. John Authers, Bloomberg opinion columnist, actually writes in his latest column that the curve is now undergoing a bear steepening, meaning that the move is being driven by a fall in the price of long-dated bonds. With the current combination of conditions, a recession generally soon follows. John Authers joins us right now to talk a little bit more about this here. I love the title of this column, The Yield Curve Moves to a, quote, fatal disinversion. I want to talk about the potential fatality here, if you will, because when we talk about this disinversion, I feel like in the past, it was more about the Fed cutting rates and more the activity being on the shorter end of the curve, leading to the disinversion. This time, most of the activity is on the longer end of the curve. What is that telling us?
It's very difficult to tell, other than that I guess that you're still getting a fairly clear bet from the market that higher for longer isn't going to work. Implicitly, that's what we're seeing, is that there's pressure against what appears to be the unfurling monetary policy. I guess the other point, which is different from previous episodes, is the sheer supply issue. There's an awful lot out there. There's an awful lot more that has to be financed. Whatever happens, there will still be a lot of financing needs. And although I don't think this is a prime factor, the mess in the House doesn't help.
It certainly doesn't help. I think for all the folks who basically said, ignore the yield curve, that it's a broken signal, that a lot of the other economic conditions seem to be pointing to, if not a soft landing, certainly not the worst case scenario here. What's your response to that?
I think, first of all, you've always got to be careful about dismissing anything, any lesson from history, because things tend not to be different this time. It was fascinating. Joe Livorno, we've had over, Nico pointed out, he tried redoing the leading economic indicators without the yield curve. And that actually suggested that the leading indicators without the yield curve would have told you that there was a recession coming on most of the post-Lehman decade. So it actually was quite a useful indicator in dousing pessimism at that point. If you remove it from the LEI now, it makes no difference at all. So yes, you can argue it's Goodhart's law is how it's referred to in the economics. I think that once you're observing an indicator, once everybody knows that this is an issue, it will tend to go away. People will have adapted their behavior seeing the inverted yield curve, but I don't think you can call it broken.
Let's talk about the fatal disinversion a little bit more. Does it matter at all the dynamic that leads it there? When you think about a bear re-steepening versus a bull re-steepening, whether it's the long end or the short end that actually drives it back to positive territory, does it matter?
I think it matters. Certainly what is going to transpire next will be very different. If there is something we've inherently got to worry about at this point, it is somebody somewhere buckling under the problems of duration. As happens, the bank failures earlier this year were very unusual bank failures because it wasn't really about credit risk as normally understood. It was about very serious duration risk. If you see this kind of move at the long end, that is what is going to get people very worked up. I think you get into the issue that rates stayed far too low for too long during 2021, which allowed plenty of people to lock in rates for longer than would be usual. I think that's why there is an unusually long lag. But the way the bond market is moving at the moment, I think that is it's not necessarily through a slowing of economic activity. It's more of a financial event that we need to be concerned about.
And just really quickly on that last point, the moves that we've seen in the last couple of weeks, particularly at the long end, you read a lot, you talk a lot to a lot of smart people. What's the read? Is this something fundamental, or is this more of those technical factors?
I think it's something fundamental. I think it's still only just getting through to many people that the great post-Volcker era of a chart of 10-year yields is one of the most boring charts in finance for a long time. It just reliably went down. And that is not an anchor that we can grab hold of anymore. You never know what the catalyst will be. I didn't think what Jerome Powell said a couple of weeks ago was any particular reason to change your view about what was going on. Yeah. But that turns out to have been the catalyst for what's underlying that is people have got to grasp that the assumption of low yields is just no longer extant.
All right, that's a great place to end it. Always a great conversation and a great column every day put out by John authors right here on the Bloomberg terminal. Coming up here on the big program, you're going to hear part of my conversation with the comptroller of New York State, Tom DiNapoli. He really talked a lot here about pushing back against some of the ESG critics and how to guide the third largest pension fund, state pension fund in the nation here in the higher rate environment. That conversation coming up next. This is Bloomberg. All right, New York State has the third largest state pension plan in the country. And a little bit earlier, I had a chance to sit down with the state comptroller, Thomas DiNapoli, who is the sole trustee for that fund. It was part of the Bloomberg Sustainable Business Summit. And he talked a lot about the pension fund's investments and his role in trying to foster a greater sustainability, not only for the fund, but also for the world at large.
We have a climate action plan that we developed a number of years ago. And the real focus of that plan is to examine our holdings from the perspective of transition readiness. Understanding that some of the companies that folks might be concerned with their business practices today, the question really is, where are they headed? Do they understand the imperative of the goals of the Paris Agreement? And what kind of business plans do they have in place to achieve those goals? And you know, from our perspective, again, being a pension fund, and a large one, you know, our preference is to buy and hold, right? Because we're a perpetual investor. We're not going out of business. We don't have really short-term interest. We have long-term interest, and we're well-funded. So we're very patient capital. So we view ourselves as being perpetual and universal. There are exceptions to it. There are obviously some places we choose not to go to, but you know, looking at the list in that presentation, all those company names are very familiar to me.
How are you making decisions, though? I mean, when you sort of go through your criteria for what sort of meets the standard of sustainability, what meets the standard for the E, the S, and the G, how do you go about that process?
Well, you know, I know this is such a hot topic and obviously the focus of the summit, but I would say, you know, from my perspective as trustee for the fund, I want all of our investments to be considering the ES and the G. As a provider of retirement benefits for 1.1 million New Yorkers, I want all of our investments to be sustainable. So I don't think, from my perspective, we quite see it so segmented or so bucketed out. We would like to have all of our investments have a consideration of what we consider to be risk factors. You know, if you're not adequately assessing the impact of your operations on the broad categories of ESG, then perhaps you're missing opportunities to maximize return. It gets back to risk and return. And again, because we have a perpetual horizon as a pension fund, we want all of our investments to be sustainable. And we think sustainability starts with incorporating ESG considerations.
How do you, though, I guess, make that case? I mean, to, of course, the folks that you're effectively working for, meaning the pension holders. But as I'm sure you know, there's been a lot of criticism overall, not just of New York State, but other state pension plans, and the way that they ventured into this. Has the case not been made eloquently enough, accurately enough, that there is a direct financial component there to pursuing these strategies?
Well, I mean, from my perspective, we made the case eloquently enough. And, an advantage I have as a sole fiduciary model is that, I make the decisions and the decisions stick until somebody replaces me. Look,
is that going to happen soon?
No, it's not going to happen anytime soon. I just got reelected last year.
You paused. All right, I'm just checking.
Yeah. I'm not ready to collect my pension yet. No, I mean, and from my perspective, when you see some of what's happening in other states, and you see some of the proposals, at the federal level to limit consideration of ESG, I mean, it is unfortunate it's become part of the political landscape. It shouldn't be. And from my perspective, as the fiduciary for the fund, I want to be left alone to make the decisions, which is my responsibility, that investment decisions that are in the best interest of our members. That's our purpose. And so, from my perspective, very strongly, I would be not fulfilling my fiduciary responsibility if I was not ensuring that our staff wasn't considering these factors in all of our investment strategy. Again, it's about reducing risk, maximizing return, and so you want to be invested in places where there's an understanding that how the environment is being managed, how employees are being treated, what kind of board governance structure you have. This will have a direct impact on the the long-term profitability of whatever the company or the investment opportunity is. You can't separate it out. So we get into this labeling and the politics, and to me, it's separate from that. Let me just offer this other thought, which may sound counter to some of what some of you may be thinking or talking about today. We don't view what we do as ESG investing. We are investing to secure retirement benefits, and we believe that considering ESG factors is totally tied to the effectiveness of our overall investment strategy.
All right, that's the New York State Comptroller speaking a little bit earlier at the Bloomberg Sustainable Business Summit going on right here at Bloomberg World Headquarters in New York as we count you down to the close here on a Thursday afternoon where stocks remain on the back foot, a bit of a waiting pattern ahead of a big jobs report, 8:30 a.m. Washington time tomorrow. Romaine Bostick and Katie Greifeld here on the close. This is Bloomberg. This is the countdown to the close. The cross-asset space volatile once again here. A bit of a holding pattern for equities ahead of a big jobs report tomorrow. But let's check in on what's going on in the commodity space right now. A lot of red on the screen. Abigail Doolittle standing by with our commodities close.
There is some red on the screen, but we also have some relief from yesterday's big selling because yesterday for the commodity index, it was down more than 1.5%. Natural gas today getting a bit of a lift, up 6.7%. Wheat also having a nice day, up 3% in what is a dismal year. To the downside, though, and to your point, Romaine, Dr. Copper down 0.7%. But the big commodity that we're all watching over the last couple of days, because the sell-off has been simply stunning, is WTI crude oil down 2.3%. The selling started last week after the peak at $95 per barrel. If we take a look at a chart over the last, I think, month or 2 months, we're going to see the move higher and then the reversal lower. It's really a pretty big move that is occurring there. And up on the upside, it was from the bottom up 39%, and then over the last 6 days or so, Romaine, down more than 10%. The big question is sometimes when you see this kind of a crash for commodities, it can bleed into stocks a few weeks later. And here we are, basically a round trip from the beginning of September to the beginning of October. Net down 2.8%.
All right, nice round up there by Abigail here on what's going on in the commodity space. Let's turn now back to Washington and politics. About 48 hours removed from that man, Kevin McCarthy, being removed from his post as Speaker of the House. And the big question now is who's going to replace him and what happens when the deal to avoid a government shutdown runs out in the middle of next month. Joining us right now is Kim Wallace, 22V Research's Senior Managing Director and Head of Washington Policy Strategy. And Kim, let's start off here, first of all, with the potential replacement. Steve Scalise throwing his hat under the ring, Jim Jordan as well, maybe a couple other names that pop up over the next couple days before we get to the vote. But I guess the big question I have is if it took Kevin McCarthy 15 rounds of voting to become Speaker of the House, do you think that the candidates that we know of right now are going to have an easier time at it?
Well, it's possible, Romaine. Of course, we don't know. We're in unprecedented territory here. But the latest momentum is behind the slate that Mr. Scalise and Mr. Jordan would join together as a 1-2 punch. If that comes to fruition, my guess is they could be finished with this on Wednesday, and it might only take one round. Of course, you have to leave space for other outcomes that are difficult to imagine now. It's more than likely, in my view, that House Republican Conference will be able to settle on the Speaker sometime next week.
Mm-hmm. Well, what does that mean actually for legislation going forward, particularly in light of kind of the unresolved issue of the budget? I mean, if Kevin McCarthy got booted for effectively, let's just call it what it is, compromising, I would presume that anyone who replaces him is going to have a lot of pressure not to cave in to anything that the Democrats ask for going forward.
That would seem to be obvious. My guess is that House Republicans are going to have to decide whether they want to change the rule that effectively led to McCarthy being deposed. That is, one member being able to call the question to vacate the chair. That rule in place means that whatever happened to Kevin McCarthy the last 8 months is bound to happen to every speaker between now and the time that rule is in place. I would look to that as an indicator of how serious the House Republican Conference is about changing the optics of how they govern and deciding what to legislate on, focusing, as you say, on fiscal policy, both in the near term, November 17th, and what I think will be a December very busy period on fiscal policy.
Well, if this is bound to happen again and again, of course, we're about a year out from the 2024 presidential election. How does that coincide with that election, with the campaign, and what we're going to hear potentially from the candidates who I'm sure are going to make talking points out of this?
Well, Katie, good point, because it's been rumored recently that former President Trump is going to actually go to Capitol Hill to express views. Whether or not that happens, we'll wait to see. But it is, I think, an indicator that how the House governs itself, what that looks like to Americans who are not focused on, as we say, inside the Beltway parlor games. They're more focused on some of the issues that Mr. DiNapoli was talking about, that is household economics. It's not a good place to be. It certainly has the potential, the disarray, should it continue, of influencing thinking of funders of the Republican Party in the House, and then ultimately voters, and picking among the A and B choice of November 5th, 2024. That's a long way away. My guess is that the leadership in the House Republican Conference understands this as well as we do, and they're going to attempt to remove that as an issue to be discussed.
Well, before we get to November 2024, we have to get through November 2023 and the possibility of another government shutdown. If we do see a shutdown, given the disarray, maybe there is another House Speaker by that point, but maybe it'll be contentious. What could that possibly mean for how long a potential government shutdown would last?
Of course, you appreciate, Katie, that's all highly speculative.
Of course.
My sense is still that the majority of Republicans, as was expressed 2 days ago in their vote on the speakership, understand that less volatility and less drama is good for them. My guess is that's a guiding principle that will force them to decide whether or not to shut down. Just as the beginning of the fiscal year, there was very little political or financial payoff for any member of Congress for a shutdown of government. That hasn't changed. My guess is we'll get close to November 17th, if not really close to November 17th, and there'll be an agreement to continue government operation. Shutdown isn't a good campaign ad.
Kim, it's great to speak with you. Hope to check in with you again soon. Our thanks to Kim Wallace of 22V Research. Now, still ahead on the close, early orders for the iPhone 15 Pro Max have been better than expected, but that's not easing concerns over weaker consumer demand. More on that next. This is Bloomberg.
All right, let's get a view from the sell side with our top calls, big movers on the back of analyst recommendations. And let's start in the mortgage finance space. UWM Holdings getting a boost today to buy over at BTIG, with the analyst citing deepening liquidity in the stock and says raising new capital could actually feed growth if the company times it appropriately. Shares having a great day, up 8%. Next up, let's take a look at Clorox. Not a great day at all. A downgrade to market perform. This over at Raymond James as the cleaning products company continues to come clean about the fallout from the August cyber attack. The analyst says that Clorox will need time to revamp operations, which could result in a loss of sales and the need for an increase on spending on promotions. Clorox shares down 6%. And finally, Carrier. Bank of America downgrading the HVAC company to underperform, citing a lighter market in the U.S. and concerns about heat pump demand in Europe, the latter of which is particularly impactful for Carrier, given its deal to buy Weissman over there in Germany, whose revenue primarily comes from heat pumps. Those shares down about 1% on the day, and those are some of our top calls. We want to stay in the sell side space and take a look at an interesting call that came out yesterday on Apple. Apple hoping to fend off waning demand after releasing its latest slate of iPhones. But Brandon Nispel over at KeyBank Capital Markets warns that U.S. sales are likely to struggle as customers, quite frankly, just hold on to those older models. It's part of why he cut the rating to sector weight from overweight. He joins us now to talk a little bit more about the issues for Apple. And let's just get this out of the way, Brandon. We know Apple is a juggernaut. It is a cash machine here. But when you look at the current valuations and you look at the prospect for whatever additional revenue growth they might get out of their existing product lines here, kind of square that circle for what investors should be paying most attention to.
Yeah, thanks for having me on. So our view is that the U.S. business is going to be challenged from a growth standpoint. We've seen upgrade rates hit all-time lows, and then expectations going into next year really call for a hockey stick in growth acceleration internationally, and we sort of question that, especially with the emerging risk of competition in China from Huawei. So we think Apple is ultimately going to grow lower than consensus expectations next year. We're modeling 3.5% growth, which, for most investors is a very low growth business. And consensus expects more like 6%. So we see some risk to those expectations. And as we look at valuation for Apple, Apple is still trading at a relative premium to its historical average and multiple turns above other peers in NASDAQ that could be growing faster.
And Brandon, when you put that all together, what is the catalyst that Apple would need to see here? When you think about things that could potentially really juice excitement over these iPhones, over the stock in general, what's in the range of possibility?
I think the bulls on Apple go back to the user growth in the business, right? This is a company that across the globe resonates with consumers and has a highly demanded product. Market share penetration rates in some emerging markets such as India or Brazil or even China. Those are the areas that I think the bulls are excited about. And so really what the bulls would probably want to see is less competition in some of those markets, particularly China, because that's been sort of part of the bull story over the last couple of years.
And is this an Apple-specific problem, or is this more about the macroeconomic environment that's kind of affecting all of its competitors as well?
I think you can argue it's a little bit of both. I think from a macro perspective in the U.S., consumer spending seems to be on a softening note. And then just if you look at, carrier promotions in the U.S., they're no different than they were before or last year, and arguably could be said to be more restrictive, meaning they require customers to purchase their higher price rate plans. And that means, for consumers to get the best deal, they have to actually spend more money, which in a challenging macro becomes more difficult.
All right, Brandon, great stuff and great to catch up with you here. Brandon Nispel there over at KeyBank Capital Markets. A look here at Apple shares higher on the day, but well into correction territory from the highs set back in July. We want to turn our attention real quick to Mirati Pharma Therapeutics, MRTX. The shares had been halted, now reopened, surging about 30% here. This on the back of a report here saying that Sanofi, this is the big French drug maker, is said to be exploring acquisition talks with the company. Now, we should point out Mirati has been working on a lung cancer therapy here. Sanofi is not quite clear exactly what details are behind this. We should point out before the share surge here, this was a company valued at roughly about $3 billion in the public market here. You add to that the 28-30% pop that you're seeing right now here, and it'll be interesting to see how all this shakes out. We'll try to get you some more details on that story. In the meantime, we do want to go back to the labor market here with the big jobs report on tap tomorrow. We had a chance to sit down today with Ronnie Chatterji, the Duke University professor of business and public policy, and get his thoughts about U.S. government and its investment in the manufacturing sector. That conversation coming up after the break. This is Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week daily segment with the host of Wall Street Week, David Weston, who joins us every day around this time. And David, this has been a busy week for jobs data here in the U.S. And of course, we get a big report tomorrow on Friday, the monthly jobs report. And I know you had a chance to sit down with someone a little bit earlier today and talk a little bit about manufacturing jobs.
Well, exactly, because as you know, we've talked about, Romaine, the U.S. government right now is investing so much money in manufacturing, whether it's semiconductors or it's electric vehicles. And we wondered how that fits with what we're seeing, for example, at the auto industry. So we turned to the man who was the coordinator for President Biden, actually, of the CHIPS Act. He's now at Duke. He's Aaron Chatterji, professor of business and public policy at Duke University Fuqua School of Business.
I was the CHIPS implementation coordinator, so I saw firsthand the impact that investments in semiconductor manufacturing, computer chips, are making all across the country, including in my home state of North Carolina. And you're right, it is a real pivot for the administration for the first time in many, many decades to invest in American manufacturing. And you're seeing that not just in chips, but also in a lot of clean tech industries, including wind and solar and carbon capture. And the idea here is that it makes sense from a national security perspective and from an economic growth perspective to make more of these things in the United States of America. And so I feel confident that if we're strategic with how we deploy the money out of the CHIPS Act, the $52 billion that I was overseeing in my time at the White House, and the hundreds of billions of dollars of tax credits in the Inflation Reduction Act, we can get this right. But it is an execution question for the government and something we should all be watching closely.
So, Ronnie, let's pick up on that 92% number. Okay, that's not the number we want right now. That's not good for our national security. How far down do we have to get that in order to make it healthy for the United States government? That's to say, I assume we're not going to try to take over 92% of manufacturing of those high-end chips, right?
You're correct, David. We do not need to produce everything in the United States in any of these sectors to achieve our goals. In fact, if you think about a lot of valuable resources, we might have a stockpile in the United States. We might have some production capacity that represents 10 to 15% of a market. In many cases, if we can make sure that we have enough supply or the capacity to produce supply of these key inputs, let's say in times of geopolitical crisis or a pandemic, that can be enough. We do not need to make everything in the United States. I'll also say these supply chains are complicated. Your viewers know this from the business world that, look, the semiconductor value chain, it stretches across the globe and goes around at least 3 times. And so we're not going to be able to do everything in that complex supply chain here in the U.S. But we can do some of it, and we can make some of the chips that we haven't been making now if we invest in America. And that's really what the Chips and Science Act is all about.
One of the things I understand the United States has had and maintains an advantage in is design of the high-end chips rather than manufacturing. We're not so good in fabs, but we're better at the design. Is there money that the United States government needs to put forward in order to make sure we maintain that lead?
We definitely need to maintain that lead. And as you're right, the American companies lead the world in chip design, although it's a very competitive space as well. And you see this in a lot of industries where we've taken a global lead in terms of the design and the higher margin activities of the industry, but manufacturing has gone elsewhere. And I think that has 2 costs. One is if we don't make stuff here, we might be less likely to figure out what the next big innovation is in that space. And so these investments in manufacturing will also increase the chances of innovation potentially in the upstream. The second second thing is we need to invest in research and development. It's not enough to make the chips here in this generation or even the next generation. We have to make sure that we're coming up with the ideas in the United States to develop these next generation chips. And so there's an $11 billion component of the CHIPS and Science Act that will invest in research and development here in the United States. That's a big part of the program and a big part of the overall strategy.
Ronnie, these major investments the United States government come at the same time as there's major shifts going on in the overall economy, both with respect to clean energy and with respect to artificial intelligence. Let's talk about clean energy for a moment, because I think we're seeing that come up in a way in the UAW negotiations right now with the auto workers, because there's a lot of concern by the auto workers. Understandably, there aren't going to be as many jobs. They're going to be left out, particularly as they go to joint ventures for some of the battery plants. You and I aren't in those negotiations. We don't know the details of them. But in a broader sense, how can we move forward to embrace the new without leaving behind workers from the old?
I mean, this is personal, I know, David, for you and for me, given where we're from and the industrial bases of the states we come from. When you think about it, and the Hollywood writers and actors strike falls into this category as well, we're negotiating right now to think about how the future of technology is going to transform our industries and what the split is going to be between the people who own the companies and the people who work for the companies. And I think in some sense, the UAW strike against the big three is part of that discussion. As we transition to electric vehicles, we're going to have different kinds of jobs in those industries. And electric vehicles are going to create lots of fantastic jobs across the value chain. But the change between making an internal combustion engine and a battery is going to lead to different skills, different kinds of requirements, and potentially different wages. And that is what the strike is all about. These joint ventures between foreign companies and the big three aren't always covered by the agreements that UAW has with the big three automakers. And so a lot of the negotiations, I won't say all of it, a lot of the negotiations is probably about, as we transition to electric vehicles, how are we going to split the gains from this amazing market opportunity? It's also in the context of broader competition, because not all the companies in the auto industry are working with unions. And so you think about other competitors, whether it's Tesla or a lot of the foreign automakers who are concentrated in plants in the Southeast, this is going to be a competitive landscape. And right now, UAW and the big three are trying to find out how they go forward and compete effectively so that we can all win.
So you worked right at the intersection of all of this in the White House as a policymaker, dealing with the private sector as well as the public sector. How do we go about getting the right people in the room? Because you just say Tesla's not in the room in the negotiation with the UAW. But by the way, I'm not sure what the role of government is either, so that we come out of this with some overall approach that says, yes, we can embrace electric vehicles, that specific technology, but we can still maintain the manufacturing base we need.
This is right. I mean, government can play a really great convenient role and use the bully pulpit to try to get the right players in the room. I think it's key in government and in business to be humble about what we're trying to do. You know, when I hear the critiques of these investments in manufacturing, I listen to them. I think folks have a point when they talk about the past errors that we might have made in industrial policy in the U.S. and around the world, and you try to get it right. And it's a back and forth between government and business. And you're seeing that in the CHIPS Act, the Inflation Reduction Act, where the Biden administration is listening to business, trying to incorporate their ideas, but also listening to all the other stakeholders, including labor and environmental groups, to figure out if we can get the right balance. You got to be humble. You got to look at the facts, and you have to think about how you're going to bring everyone along. Because in the end, what I'll say, when it comes to the CHIPS Act, when it comes to the Inflation Reduction Act, these are going to be compromises that need to be made as we move forward. And those compromises are going to be regarding how we bargain with the various stakeholders who are affected by these decisions, whether it's workers, whether it's the environmental impact, whether it's the companies that are choosing to invest in the United States. So far, I think you're seeing a lot of encouraging signs with the amount of investment that's coming into the U.S. We have to keep it up, and that means you got to stay flexible, stay humble, and keep listening.
That was Ronnie Chatterji of Duke University. And I must say, I think, Romaine, this is a critical issue, certainly for investors, for businesses, for employers, but also for the administration. How can we move forward, have enough disruption to get us to the new world without leaving too much behind?
And I thought it was interesting, too, how we talked about you don't necessarily need 100% of that in the United States itself, as long as you have, I guess, some of the more key components and the design functions as well here, that it might actually succeed.
And some capacity to increase if you need to. If there is a real geopolitical conflict, do you have the capacity to increase or not? Right now, they're concerned they don't have that.
Yeah, absolutely. And interesting, too. I mean, the design side is key, too, because you need the expertise. I mean, that's where it all starts and ends, pretty much.
And that's high science and real technology that needs to be developed. Okay, so tomorrow is Friday, of course. We're going on Friday at Wall Street Week. We're going to talk with Special Contributor Larry Summers about those jobs numbers, Romaine, you know, are coming out tomorrow, as well as a wild week in the bond markets. We'll also hear some more from Bridgewater's Ray Dalio about his investing advice. That's coming up tomorrow at 6 p.m. Eastern Time.
And of course, you can catch David Weston every day around this time for our Wall Street Week daily segment. Of course, he teased ahead to those jobs numbers. A bit of a holding pattern right now in stocks and bonds as the market, I think, waits to see exactly what that report will show here. The volatility, though, still there, though we should point out that right now, most of the action that you're seeing today is in the commodity space. We round out into the final hour of trading here on this Thursday afternoon. Stick with us. Full market coverage coming up ahead. This is Bloomberg. Just about 3 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld.
Interesting holding pattern, if you will, Katie Greifeld, coming off some of the volatility we've seen in the previous days. I think everybody is kind of looking ahead right now to that jobs report that we're going to get at 8:30 a.m. tomorrow morning.
Yeah, a big one coming tomorrow. And thank goodness the government is open so that we actually do get those numbers and we have maybe a new narrative to talk about, because a holding pattern right now, but we know that nerves are frayed in this market. It's going to be really important to get that check on the labor market.
Yeah, let's check in on what we're seeing in the market today. Relatively unchanged. We should point out, of course, on a weekly basis, this is still shaping up to be another down week yet again here. And the S&P 500 right now kind of straddling around some of those key technical levels. And I wonder how much volatility we're going to get when we finally do get that number in the pre-market and then, of course, in the cash session.
Yeah, it remains to be seen. I mean, the bond market blissfully will be open, so we'll see. And, of course, we've seen yields actually come back in a little bit.
Blissfully will be open. I feel like it'd be better if they were all just closed.
Maybe. I did see a note that said, thank goodness the bond market's closed on Columbus Day. It's done enough damage. But in any case, I think that'll be really important. Not what happens necessarily at the front end with those Fed expectations, but what this means for the long end, since that's really been the epicenter of volatility.
Yeah, absolutely. You see the 30-year yield there right now, still kind of hanging out where it was yesterday. NYMEX crude, the downdraft here, the second straight day of declines here, now testing back down at that 81 level. And the second line of your screen here, we don't talk about Mexican stocks much here on the program here.
If at all.
That's if at all, and this might be the last time. But down 3% on the day, and this is all because of some weird report about airport fees that AMLO is considering over there. Now, the government hasn't really confirmed this, but the market just sold off. This was actually the worst day that the Mexican Bolsa has seen in a couple of years, and some of the names in that index were down like 30-40% on the day.
Yeah, and you can tell just by the magnitude of those drops, both at the specific stock level and the index level, that this was really surprising.
Yeah.
I didn't really know what to make of it. It seems like markets didn't either.
I'm glad that we can surprise you from time to time, Katie Greifeld. If you can flip up the board here, because I also just want to point out real quickly something that was brought to my attention, and that's kind of the resurgence of growth stocks, which seems kind of counterintuitive, though we talk about this idea how growth, to a certain extent, has kind of become the defensive position. You're looking at right now the weekly performance, and this is globally. We should point out the chart you're looking at here. So the green line that you're seeing on the far right of your screen, that's for this week so far. And then the previous week, we also had outperformance versus value.
Yeah, I think that's a really interesting sort of narrative flip that, okay, growth, it's supposed to be hit by higher rates, but you think about what actually is growth, it's big tech, and big tech is awash in cash. Maybe that's why it's taken on a bit of a new character in this environment. But for more, let's welcome in Bloomberg cross-asset reporter Emily Griffeo. And of course, there's a lot of drama in the stock market, but there is a lot of drama in the bond market, specifically when you look at ETFs, because we had Bill Gross on yesterday actually telling us about how much volume there's been in some of these fixed income ETFs. And you take a look at HYG, holy moly.
Yeah, I mean, Bill Gross was right. He was talking about the record volumes. HYG saw an all-time record since its inception, about 10 billion shares trading hands the other day. And we're also looking at TLT, that's iShares 20-plus year Treasury bond ETF, one of the largest long bond ETFs, also seeing its highest volume since the height of the pandemic back in March 2020. What's interesting about the long bond ETFs is we're still seeing investors buy, and we're seeing those funds track in positive inflows. TLT has about $17 billion year to date. Bloomberg Intelligence calls these investors duration addicts. That
duration addicts.
Want to get in there.
But is that a bet, though, on the idea that we may have actually reached the peak rates? If we're not there, some people think we're actually very close to it.
Yeah, I mean, I speak to a lot of sources who say I want to lock these rates in right now, but that's a really big question right now as to whether yields can go higher from here or not. There was at least a survey from BMO Capital Markets just ahead of the jobs report. 73% of BMO clients believe that 10-year yields will trade at 5%. I mean, that's more than a majority here waiting for these.
Well, that's why it's interesting. Whether you talk to a Treasury bull or you talk to a Treasury bear, they all seem to be in relative agreement that at least in the short term, yields are going to go higher. And I know some of those people would argue that we could see a drop back down into the mid to low fours pretty quickly here as well. But I also thought it was interesting because I saw that Bill Egan over at who runs this JP Morgan Strategic Income Fund, he basically said like 60% of his fund is in cash, so basically commercial paper. And then the other like 30-something% of that is basically just in short dated investment grade debt, which I guess would benefit if yields continue to move higher.
Yeah, it makes sense. All year, people have really been adding to cash. It's that same question that we've been talking about why would you invest in stocks if you could get that guaranteed 5% rate of return on your cash. And we're seeing that in the ETF flows as well, that these cash-like funds have really been taking in money. Then you look at something like the high yield area, at least there, the story is a little bit more clear. The funds are falling, and we're also seeing outflows from funds like HYG.
And that's interesting because I feel like you've been seeing outflows from the likes of HYG, J&K, some of these other big junk ETFs all year, even though for a while these funds were actually outperforming, doing really well. It feels like that was a rally that just no one wanted to buy.
Yeah, more and more sources have been warning about credit card delinquencies rising. Torsten Slok over at Apollo, it seems like every day he has a note out about how bankruptcies are rising and he's soon expecting a credit crunch to happen. But we really haven't seen it just yet. Spreads so far are pretty much under control, but we are seeing those outflows again from some of these funds.
All right, Emily, great roundup. Really great to see you. I'll see you back at the desk. We actually sit next to each other.
Do you?
Romaine.
Oh, I didn't know that.
Back to back.
Back to back.
Yeah. All right,
so
I'll
was
see
this
you
a setup? Because I feel like we started the show was talking about real yields.
Yeah.
We're now talking about ETF flows. What's next? You have another show?
I just Machiavellian this whole encounter. But we should actually talk a little bit more about the equity market because outside of all the drama in the bond market, there's a lot of single stock names on the move right now. We should talk about Rivian, Romaine, because it is having a terrible day. It's down 21%. Of course, it announced plans to issue $1.5 billion in convertible debt. And this was expected, but it was earlier than expected.
Well, that's what I don't understand. I mean, this seems like a pretty severe market reaction for a company. Even if they hadn't said publicly that they were going to do this, you knew they needed to go back to the till at some point here.
Exactly.
So is the idea is just the timing that's throwing investors off?
I think maybe it's the timing. Again, what does it say that they chose to go earlier than expected? Maybe that's sparking some speculation, but I agree, 21% in a single day.
It means that they needed money.
It means they needed money.
That's not necessarily a bad thing, especially if they get the money.
I don't know. Maybe you could take the other side of that trade. But in any case, let's also talk about Clorox quickly, because Clorox, of course, the victim of a cyber attack back in August. But it came out with some more details about what that's going to mean for its bottom line. Investors punishing the shares, as you can see, off by almost 6%. And really quickly, I wanted to talk about Constellation Brands because reported earnings, and it was disappointing. As you can see, down about 3.3%, just not enough to get shareholders excited here.
Are people not buying beer and wine anymore?
I guess not, Or there was some concern about the weakness when it came to gross margin, and Wells Fargo actually just described the overall performance as good, but, quote, not good enough.
All right, well, I'm going to have a couple beers after work to help this company out. In the meantime, we actually had a chance to sit down with San Francisco Fed President Mary Daly. She spoke with our very own Lisa Abramowitz over at the Economic Club of New York. Here's what she had to say.
The bond market has tightened quite considerably, over about 36 basis points since we met in September. Well, that is equivalent to about a rate hike, right? And so then the need to do tightening additionally is not there.
And that was Mary Daly of the San Francisco Fed here in New York. A sit down with our very own Lisa Abramowitz. Let's get some insights out of our next guest. Bryce Doty joining us right now to help us count down to the close. He's Senior Portfolio Management over at CIT Investment Associates. And Bryce, we have to start off with the bond sell-off. I know a bit on pause today here, but when you look at the volatility and just the velocity of change that we've seen in the Treasury market, and for that matter, in the broader fixed income space, I'm wondering what signal you're picking up from that.
Yeah, well, after hearing the last clip there, I'm hoping to get the signal of a thank you card from the Fed. We're doing the work for them, and I do think it is true with mortgage rates approaching 8%. You know, that does a lot of damage. So the Fed probably doesn't need to do anything. And then when you add the headwinds and uncertainty around government shutdown and the political turmoil that's going on, I think that the Fed could just be done. If people really believe there's a huge credit crunch coming and there's the Fed is going to break something, the long bond wouldn't be going up. Recall in March when the banks were all failing, rates were plummeting. The 2-year went down 100 basis points in 48 hours. So I do not agree with this assessment that the rise in yields is like a danger sign. For me, it's confirming that the Fed is done. Long rates almost always go up as the curve tries to renormalize at the end of a tightening cycle.
Okay.
So that's the way I read it.
Okay, well, let's continue that on that train of thought here, because I've heard this argument from some other people, and they would point out, to back up your argument, that when you then look at the broader fixed income space and credit spreads and the fact that we haven't seen a material widening, at least not to the extent that you would think would be accompanied by the steepening of the curve here, is that ammunition that you can use to make the case here that this is a market that is less concerned about some sort of economic collapse than maybe what we've been talking about?
I totally agree. The 2 to 30-year inversion has lessened by 70 basis points. So we've come a long ways. And now the 2 years at 5%. If people do think that the economy is going to be fine, we're going to slow. We might stall, but we're not going to have a recession where we actually contract. Well, then flat curve is 5% all the way out, right? So the 10 and 30-year are getting to that point. Which is why we actually added duration. We actually bought some 10s and 30s earlier in the week at the near-term peak. We'll see if that was a mistake when the employment report comes out tomorrow. But we think that's going to be kind of a Goldilocks scenario that bolsters what you just said about the economy. That it's going to be okay. It's not too hot, not too cold. We're looking, as long as it's not over 200,000 jobs tomorrow morning, we think we're good on our purchase of treasuries yesterday. So I agree that that's kind of where we're going to go. But think about how the curve normalizes. Once it gets steep, it will be, it'll be with a 2-year going down in yield. So right now, the curve is uninverting with long rates going up. But 6 months from now, it's going to be a completely different picture. You're going to have to restructure your portfolio to move shorter and shorter on the curve if you want to optimize the steepening.
And so, Bryce, I mean, you just said a bunch of interesting things, but let's start with that last point there on how the curve sort of uninverts, how it gets back to positive territory, the fact that it's going to be driven by the front end. We were just having a conversation in the past hour with John Authors, who said that basically when the curve uninverts, that's when things get a little bit painful, a little bit dangerous. That's your recession signal. Do you buy into that logic?
No, I think the inversion is because people are afraid that there's something bad's going to happen, so it reflects the flight to quality at the long end. But once the crisis is averted, they're like, I think we can go back to what would normally be the case, where the more duration, the more maturity, the more yield you should get paid for the additional amount of volatility. And that's kind of a natural state for the bond market. So I think that we're going to be moving back towards that normalcy. We won't really be comfortable for maybe a year when the supply-demand equilibrium permanently kind of takes the risk of spiking inflation and shortages out of the market. There's kind of a risk premium in there that's keeping the curve from being steep already. And then if you think about the 2 years specifically, it's forecasting Fed funds 2 years from now. Well, eventually it's going to be a lot lower than where it is now, just simply because of the real interest rate level on Fed funds is just gotten pretty significant. So that's how you get the short end, the 2-year in particular, to go down and steepen the curve that way.
All right, Bryce, we only have about 30 seconds left with you. We covered duration risk. Let's talk a little bit about credit risk, because I'm reading your notes. You mentioned you're comfortable with credit, even select high yield securities. Just quickly, tell me about that comfort, because there's a lot of people who really dislike junk credit right now.
Yeah, and I'm sympathetic with the haters on the high yield. I get that, but there are pockets that there's really attractive opportunities. Like we enjoy closed-end funds with 10% dividend yields, a lot more than just buying a generic like the fund that you mentioned earlier, HYG, because you get an extra 3% income for your hassle. Plus, because people are so negative, it's reflected in the discount on closed-end funds. You can buy these funds 10% below market value. So that's a way to take advantage of that negative sentiment and give yourself a ton of upside. We expect double digits out of that trade.
All right, Bryce, it's great to catch up with you. Really appreciate your time. That is Bryce Doty of CIT Investment Associates. Now, coming up on the close, as New York's congestion pricing plan gets closer, stirring up debate all over the city, we're going to look at arguments on both sides.
Both sides? No, there's only one side in my world. We're going to also get some insight on the health of the consumer for the upcoming holiday shopping season. Patrick Brown at Adobe Digital Insights is going to be joining us later.
And as we head to the close, we'll get insight on the markets from David Spica, president of Guidestone Capital Management. All that and more coming up. This is Bloomberg.
Markets in a bit of a holding pattern here on this Thursday afternoon ahead of a big jobs report on Friday morning here in the U.S. But of course, a lot of the damage has already been done from the volatility that we've seen earlier in the week. Volatility sparked primarily by what we saw in the bond market, in the FX space, and the spillover into the equity space as well. Not much to really write home about here in terms of the movers, whether it's to the upside or to the downside. You see some of the big stocks here on the day. You can find EQT and some of the names in the energy space actually moving a little bit higher here on the day. No real catalyst, so maybe that's a little bit of a clawback of some of the losses from the past few days. Two interesting stories overseas, including in Europe. Alstom came out with an interesting profit warning. That sent the shares down 38%. And over in Mexico, you see two of the big airport operators down about 27% on some confusing dialogue coming out of the president there and the change in airport fees. Meanwhile, back here in the U.S., if you're looking for help from the Magnificent Seven, you're not really going to get it. NVIDIA really one of the only members in that group right now, pushing higher with Amazon and Tesla decisively lower. Time now to bring Abigail Doolittle into this conversation, as we do every day at this time, for our Options Insight segment. And Abigail, you're taking a look at what the next pain trade could turn out to be. I'm still obsessed with the current pain trade.
And the current pain trade having something to do with bonds, but it sounds like you might have some ESP, Romaine, because we are going to talk about the Magnificent Seven indeed as a part of the new pain trade. Steve Sosnick of Interactive Brokers, thank you so much for joining us. And I think it occurred to you, something that we all have a strong sense of, is that these 7 mega cap tech stocks, that they all kind of move together in tandem, and that was true yesterday for the gains. But is the correlation stronger? Is that why you think that this could really be a potential problem?
Well, they've tended to move even more as like a single sector, even though they're only loosely related. We can go through all the loose correlations, but we don't have time for that. But bottom line is, this week, prior to today, all 7 moved in the same direction each of the 3 days. So I went back and saw how often does this happen. And over the course of this year, 55% of the time, 6 or more of them moved in one direction. And in the past 2 months, 62.5 for 5/8 of the time, 62.5% of the time, they moved together. 6 or 7 of them moved together. So they're moving in tandem, and that's really emblematic of the flows that are coming in and out. And that, to me, is the risk what happens if they go out?
Yeah, absolutely. And especially when you're given the fact that the equal weight S&P 500, it is actually down on the year now, down by about 3% or so, really underperforming the S&P 500 itself, helped out by those big tech stocks that maybe are lower in the near term, but on the year are certainly still higher. So let's connect this to a conversation that we had back in August. The idea that higher rates, higher stocks going together this year is very similar to 1987. We all know what happened in October. Something broke. Is that a scenario that you see now that we're in October?
Yes, but I mean, history rhymes, but it doesn't repeat. We don't have portfolio insurance. We don't have some of the specific things that happened in 1987. But as we discussed then, what I saw in 1987 was a bear market. Bonds were grueling, terrible. Nobody wanted to own bonds, but meanwhile, the stocks were zooming. And then you started to see some asset allocators move out of stocks into bonds, August, September, and that sort of broke the dam, so to speak, and down we went. Does that happen in the same exact way? Not necessarily, probably not. But does it mean that I would expect to start to see some asset allocators moving out of bonds out of stocks into bonds? Yeah, and where does that go? Especially, again, if you have 7 stocks dominating the narrative.
Yeah, and it's interesting to me right now that we have oil breaking down, because whenever we see a bit of a commodity crash, whether it's May of 2006 or the springtime of 2011, severe stock selling seems to follow. So it's going to be interesting to maybe throw that into the mix. Let's bring in the VIX, though, because, of course, this is Options Insight. And on Tuesday, there was a brief inversion, and a few of you, guests who regularly join us, very excited about it. Because if it goes into backwardation, and extreme backwardation, that would typically be accompanied by some kind of capitulation moment for stocks. So are we anywhere close there? What are you watching for? What do you see? And how do you connect this to 87 and the Magnificent Seven?
Well, we're not really there yet. As you said, it was brief, it was minor, it was more like October through December. It wasn't even a full inversion. Just to back up a little bit, when you have a futures market that when you look at it, on the chart, it sort of goes upward from left to right, sort of, like a normal yield curve, that's in contango. That means that the commodity in question typically is in relatively plentiful supply. When it's in backwardation, sort of sloping the opposite direction, that means that there's a relative scarcity of that commodity in the short term. And so when you see markets kind of getting very nervous, there's a scarcity of available volatility protection, because all of a sudden everybody decides, plane's hitting turbulence, I want to buy a parachute, that kind of idea. And so, what I look for is, that to me is a big sign of capitulation. A market bottom is usually accompanied by a severely inverted backward futures curve in VIX. We haven't seen that yet. We've come off of major complacency just to get back to a flattish curve.
That's such a helpful explanation in terms of that scarcity of supplies. Everybody rushes to go buy protection or puts or buy volatility, basically in the expectation that it could get worse, and then kind of the opposite happens. Steve Sosnick of Interactive Brokers, thank you as always for joining us for Options Insight. And from New York, this is Bloomberg.
Well, New York may soon become the first city in the U.S. to enact congestion pricing. In order to reduce traffic bottlenecks and raise funds for transit improvements, it's planning on charging as much as $23 during peak periods, $17 for off-peak for every vehicle that enters Manhattan south of 60th Street. So I guess you got to take the bridge, Romaine.
Or, just don't leave Manhattan. How about that?
Sure.
Or enter Manhattan for that matter. Look, everyone's going to wring their hands over this, but look, this thing is happening. They've already put up the little tolls outside. It's just a matter until they flick the switch and turn them on.
There you go.
R.I.P.
This is Bloomberg.
This is the countdown to the close. About 30 minutes left to go here in the trading day, a day that we've been seeing, Katie Greifeld, a bit of a holding pattern ahead of that big jobs report tomorrow.
And look no further than the S&P 500. It's currently about flat at the moment, so not too much to speak of when it comes to the actual index. Of course, you take a look at the sector level, pretty much the same thing, Romaine. Again, a holding pattern. Things are pretty mixed.
Yeah, let's see if we can talk about some of the individual movers out there. I was taking a look at those magnificent 7 stocks. I bring that up. Steve Soshnik, of course, has just sat down with Abigail. They are coining that term here. And, well, with the exception of NVIDIA, most of them are still kind of fluctuating between gains and losses, a few of them deep in the red. That includes Netflix, down about 0.9% on the day. AMD not doing much better here, also down about 0.8% on the day. If you're looking for a catalyst or even looking for a narrative here, you're not really going to find one. This right now seems to be much more of a technical driven market here as they await more macroeconomic data. If you're looking for a bright spot out there, French fries, you'll find it there. Lamb Weston, of course, known primarily, of course, for those frozen French fries, came out with their earnings. They were good. They also provided guidance, and it was even better. Those shares having their best day since early January, a few ticks higher. It's going to be their best day of 2023. Meanwhile, Carvana having another bad day, down about 4 or 5% on the day. 4th straight day of declines. A lot of concerns right now about that company's cash position and maybe the potential need to come back to the market, Katie, for new financing.
Well, let's focus on credit conditions right now, specifically in the restaurant sector. Overall profitability is improving, and that's largely driven by lower food costs. But labor inflation, it remains an issue, along with cautious consumer spending. Joining us now to break it all down is Ashley Allen. She is corporate credit research analyst over at Franklin Templeton. And I want to start with the labor picture because, of course, you are seeing some relief when it comes to those food input costs. But how much of is that overshadowed by what we're still seeing in the labor picture for some of these restaurants?
It's a great question, and thank you both for having me. You know, labor is still a bit of a challenge for restaurants and restaurant operators. Less so on the supply side. Restaurant operators have talked about seeing an improving labor pool to pull from. But on the cost side, you know, on average, labor is still inflating about mid-single-digit percentage on a year-over-year basis. That's providing a bit more of a headwind than I think that we thought we'd have at this point kind of in the year or in the cycle. Food inflation, as you mentioned, is coming down. It's still elevated. Food inflation is running mid-single digits as well. But on the whole, profitability is improving for the restaurant operators that we cover and that we see today.
And how does this all translate into top line growth? When you think about those competing sort of forces, and then you lay on the fact that you do have this more cautious consumer emerging?
Yeah, so we're seeing bifurcated trends, and I would break it out between the casual diners and quick service restaurants. So casual dining has suffered a bit more of a traffic decline we've seen in recent months. QSR, quick service restaurants, you know, there's pockets of growth, pockets of traffic decline. Overall, I would call it flat. That said, you know, our fast food operators are generally more resilient in times of consumer stress as they trade down from higher priced meals to something that's a bit more value oriented.
Well, let's talk about the casual places for a little bit here, because we have heard some commentary from some of the executives, including Darden, as well as over at Brinker, the idea that store traffic is still holding up, but the people who are coming in aren't necessarily spending as much. They're either getting cheaper meals or skipping, you know, the bottle of wine or something like that here. What's the sort of, I guess, cash position of a lot of these parent companies here? Are they going to be able to weather a decline where their costs are still elevated, but the people coming in the door are spending less?
Yeah, so broadly speaking, yes. Like balance sheets are very healthy. Leverage is kind of at a cycle low, at least as you compare it to kind of pandemic peaks. So balance sheets are healthy. And we even saw yesterday, Darden was able to come and tap the market for a $500 million 10-year note. From you know, a pricing perspective, they left a little bit of a concession on the table, depending on where you want to put fair value, maybe 5 to 10 basis points. But the markets are open for these operators. They have healthy balance sheets and solid cash flow. As it pertains to the top line, and just bringing it back to consumers, consumers are responding more to promotions. And so the top line could be more challenged, is likely to be more challenged going forward, as these casual diners are probably going to have to be a bit more promotional to drive traffic to keep that cash flow coming.
What about the quick serve restaurants, fast food chains, as we used to call them?
Yeah, so they're getting marginally more promotional as well, but to a lesser extent. And that's because they already have a value proposition relative to the casual dining space, whether it's burgers or pizza. You know, for pizza, the commentary is you can generally feed a family of 4 for maybe $30. That's not the case if you go out to one of these casual dining restaurants.
Yeah.
Let's bring this in.
Not my family of 4, by the way.
Well, let's bring this to the
There's one person in my household who I think would eat the whole pizza.
Yeah. Is it you?
No, my son.
Okay. Just wanted to check. But I want to talk about how this is translating into the credit market, because you look at the high yield restaurant index and you note that on average, it's actually trading tight to the broader benchmark. Is that rich, or is that about where it should be?
Broadly speaking, it's about where it should be. So if you think about the types of credits or the names, let's focus on high yield first, that are in that index. You have the likes of Yum Brands, of QSR. So that's going to be, again, your Taco Bells, your Burger Kings. These are the trade downs. And you know, these two companies make up roughly 70% of the index. Very, very defensive. Same thing on the investment grade side. You have the likes of McDonald's and Starbucks dart in as well. These are brands that consumers know and will still generally gravitate towards.
We only have a little time left, Ashley, but I want to get your thoughts here on all the talk over like Wegovy, Ozempic, these weight loss drugs. The interesting commentary out of Walmart, the idea that they've actually seen a correlation between their customers who are coming in to get their prescription weight loss drugs and what they're spending on snacks and other items that apparently are down. And I'm wondering, is this going to become a bigger issue, I think, for a lot of companies that maybe aren't necessarily selling the healthiest food?
It could.
Yeah.
So at the moment, I'm in the camp that it's too early to tell. I think that consumer habits kind of die hard. And there's a lot of my understanding of these drugs saying you have to take them weekly, it's for life. It's unclear what the side effects are at this time. Not to say that they're not effective and they're, I'm sure, providing meaningful health benefits to a lot of consumers, but I think big picture, it's just too early to tell with how it's going to impact habits, eating habits in particular.
Well, it's certainly making waves in the stock market. Going to be fascinating to see if it finds its way to the bond market as well. Ashley, really great to see you. That is Ashley Allen. She is corporate credit research analyst over at Franklin Templeton. Now, coming up on the close, inflationary pressures are pushing more U.S. consumers to return to layaway days. We'll speak to Patrick Brown, vice president over at Adobe, about the company's latest holiday spending report. That's next. This is Bloomberg.
Believe it or not, the holiday shopping season is actually approaching, and the folks over at Adobe, they do a great job here of tracking the trends every season. Already out with some data saying that they actually expect to see a boom in buy now, pay later services. This is U.S. shoppers start to struggle with some of the higher prices that they're seeing in the store. Patrick Brown joining us right now, vice president over at Adobe, to walk us through these numbers. We should point out you're still expecting overall holiday sales to be higher than where they were a year ago here. But let's start off with the buy now, pay later aspect of it. I guess what old timers would call layaway. I know it's not quite the same as what we were used to here. But why do you think we're going to see more of that type of activity this year rather than people just outright going in and buying what they need?
Great question, Romaine. Great to be here too, as always. And buy now, pay later has been a trend, and we've seen a couple different things over the past maybe 5 years. First, as different websites were rolling buy now, pay later into their sites, we saw a huge uptake in the demand for that service. A couple of years ago, maybe 2 years ago, when we started to see everybody largely have this capability, we saw some plateauing. And this year, we're predicting the number to be 17 billion, about a 16% year-over-year increase in the usage of that service. The big driver for that, honestly, is the diversification of the things that people are buying through buy now, pay later. And one of the biggest growers is grocery and even furniture and home. I think, though, that this is driven more by the magnitude and the size of things that people are buying. A lot of really bulk items that people can now buy in grocery, and that service is available for them to use. It's a great way to defer payments and to manage costs. So it's a little bit of the category diversification, but also leveraging a service when people are looking to manage their budgets.
It'll be interesting to see how much that drives some of the spending this holiday season. I'm also curious as to how much discounting we can expect this year, because I seem to remember last year, at least from my own personal experience, there weren't a whole lot of discounts to be found.
You nailed it, Romaine. That's it. And so we're looking at a 5% year-over-year growth in the overall U.S. retail sales. So that puts us at like 2.21 billion. Last year was like 211 or so. So that's a significant growth year on year. Last year was a 3% growth year on year. So we're accelerating on the growth. And the big drivers for that are two different things. One is entering the holiday season, prices are actually down 4 to 4.5% online. So people feel like they're starting to get a little bit of a better deal. But retailers are seeing that this is an opportunity for them. So we're predicting discounts up to 30, 35%, which we haven't seen in a very, very long time, definitely pre-COVID, to further spur that demand. So our sense is, with some early indications, that people will feel like they're really getting some deals online, and that may drive, that is going to drive the purchasing.
And Patrick, I have a little bit of a cynical question. Buy now, pay later. Do people actually pay later?
They do pay later. I think these services have actually gotten really pretty good at allowing folks to defer costs. I think the open question for us as we look at how the rising interest rates play into that and adoption of those services, I think consumers are smart and they look at these things. And so I think it'll be a factor and something that we're certainly watching.
And how does this break down on a generational level? Who actually uses buy now, pay later?
Well, it's broad adoption, and it's really more category driven, frankly. I think that adoption earlier in kind of some of the products like electronics and toys and those sorts of things, which may be bought by more of a youth market, first adoption on a lot of those services. As people are now buying grocery, and I was mentioning furniture or apparel, I think generationally that's becoming a different segment. And I think it's more of a term, and digital layaway is a great way to explain it, Romaine, I think. Mm-hmm. But that is something that we're seeing, and it's more broadly adopted even generationally. And that's a great point, Katie.
All right, Patrick, great to catch up with you. As always, some great data out of the team over at Adobe. Patrick Brown there, Vice President at Adobe. A preview here of the holiday spending trends as we round out into the final 15 minutes of trading here on this Thursday afternoon. A conversation coming up with David Spica, President of Guidestone Funds, going to get his insights on some of the market action that we've been seeing all week long, particularly headed into what's going to be a really consequential jobs report tomorrow morning, 8:30 a.m. Washington time. This is The Close on Bloomberg. This is the countdown to the close. Romaine Bostick here, joined now by Scarlet Fu, who joins us, of course, every day at this time to help us take us to the bell and beyond. But before we get to the markets here, Scarlet, some interesting news crossing the Bloomberg wire just a little while ago. This on Elon Musk, and it has to do with his with a subpoena related to Twitter. We're learning that the SEC here in the U.S. is investigating Musk over the 2022 purchase of Twitter stock here. The SEC is actually seeking to force Elon Musk to comply with the subpoena here, saying that he basically failed to appear for testimony last month here. I'm not sure we have any more details on this, but
we don't have anything more than this. This is a filing that Musk failed to appear for testimony in San Francisco, and now they have moved forward with a lawsuit here in a federal court in San Francisco. Again, it goes back to 2022. Obviously, Twitter is not a stock that trades publicly. You can't track that, but Tesla does not appear to be moving really on the back of these headlines.
No real reaction in the Tesla shares here right now, and quite frankly, you can make the case here for the broader market. There hasn't been much of a reaction today, of course, coming off of what was a pretty wild previous 3 days here, Scarlett. But this is basically a bond market story right now.
Yes.
No matter what we say about equity markets right now, the bond market is really wagging the dog.
A volatile bond market, especially earlier this week, is going to confront a major data point tomorrow. And of course, investors are now pretty much on edge before tomorrow's NFP report. There are a lot of Fed speakers today. I counted 5. I'm not sure that they said anything different. Yeah, 5 different Fed speakers.
I think I ignored at least 4 of them. I mean, I heard Mary Daly.
I think they're all singing from the same hymn book, right? I mean, this idea, higher for longer, we're going to be vigilant, we're going to wait to see, we're serious about 2% inflation target. Yeah. Nothing new on that front, but the ADP report that we got earlier this week, the JOLTS report before that, paint different pictures of what's actually happening. So I know the non-farm payrolls number is going to be backwards looking, but it will set the tone for trading tomorrow.
Sure. Sure thing. Let's get to our next guest here. David Spica joining us right now, president of the Guidestone Funds, to help us count down to the closing bells here. And David, I do want to kind of start with what Scarlett was talking about here, and whether the bond market, and for that matter, the equity market too, is finally starting to actually believe what some of these Fed members have been telling us for quite some time now, which is that rates aren't coming down anytime soon.
I think they are starting to believe it, and it's about time, quite frankly, because Chairman Powell has been very clear for a long time that rates were going to stay higher for longer. In fact, the median dot plot out of the last FOMC meeting for 2024 is 5.1%. So that's still very high. We also have what's going on with the yield curve as a function of supply-demand imbalance. The Treasury is still issuing a lot of debt. At the same time, the Fed is selling through QT, and the U.S. is in a poor fiscal situation, so there's less demand for Treasury. So all of that is conspiring to create this bear steepening of the yield curve.
I hate to ask this question here, but everyone kind of wants to know when we're going to see that top, when we're going to finally see the peaks. And I know you probably don't have that answer. If you did, you'd be even richer than you are. But when do we sort of get that inflection point or some identification that it's actually there?
That's a great question, Romaine. And I think you're starting to see people now that are starting to add duration in bond portfolios because they think we are starting to get toward the top in the 10 and the 20-year part of the curve. I would be very careful about that because the thing that's been really interesting to us this year has been interest rate volatility. We haven't seen credit spreads widen. Corporations are in great shape. They've got tremendous interest income courtesy of money market funds. But the duration issue is a problem as volatility continues. And so I don't know the real key, but at this point, we're being very cautious about extending duration because we don't know if the 10-year ends up at 5.5% at the end of the year, or if it's 4.5% or 4%. I can tell you this, though, the street does not believe it's going to be over 5%. When you look at sell-side analysts, nobody's got a 5% number on the 10-year for the end of the year, and several have 3% numbers. So nobody's prepared for a 5% 10-year at the end of the year.
And that can, of course, lead to some pretty dramatic price moves as a result. The surge in Treasury yields is certainly remarkable, but the fact that real yields are also climbing is adding to this sense of runaway price action. Explain why the move in real yields makes the overall surge in yields so meaningful and what it means for other asset classes like equities.
Sure. You make a great point, Scarlett, because the bull would say, look, real yields are still very low. And that's a function of what we've been through with this rapid inflation environment. So real yields are more important ultimately to the markets, and we haven't seen that yet. So to the extent that real yields rise even more, that's probably even more negative factor for the markets. So what would happen is you've got nominal yields staying high, inflation comes down, you would expect nominal yields to come down with it, but if they don't, then you have this increase in real yields. That's the real key that we need to look at. And again, to the extent that real yields don't go a lot higher, that's a little bit of a cushion for what we're seeing right now.
So how does that leave you in terms of where you want to be positioned? How aggressive do you want to be in taking on risk?
Well, are we talking bonds or stocks or both?
Let's do both.
Okay, so on the bond market, we still want to be relatively short. You can get over 6% in high quality, short duration bonds today. You can get over 5% in money market. Let's don't fight the Fed now. We didn't fight the Fed back when they dropped rates to zero coming out of the financial crisis. We bought equities. Today, they're taking all that liquidity out. Let's be on the short end of the yield curve. When it comes to equities, also somewhat cautious. We do think that earnings estimates are too high for next year. And we cannot fathom a scenario where the largest decline in money supply in history doesn't lead to some sort of economic issue. And that will have to be reflected in earnings and in stock prices. So we want to own high quality companies that have visible earnings growth. And historically, when you see this bear steepening of the yield curve, healthcare and consumer staples perform the best. But again, there are high quality companies with visible earnings growth throughout the S&P 500, and you really want to focus on those today.
What do you make, though, of some of the growth stocks? And I kind of put that in quotation because I feel like growth stocks have become defensive stocks as of late.
Right. Well, you kind of have to depend. Are we talking about the Magnificent Seven, or are we talking about growth companies in other parts of the market? So the Magnificent Seven clearly are going to be very sensitive to interest rates because they're long duration. They've got cash flows out in the future, so rising interest rates is going to have a bigger impact on those. But growth stocks in general, I think you should own growth stocks, and here's why. Investors will pay up for growth when growth in the economy becomes scarce. So it's a little counterintuitive. Value stocks do the best coming out of a recession when the economy is reaccelerating. Growth stocks do the best going into one when growth is slowing down. So high quality growth stocks make a lot of sense in a portfolio today.
David, fantastic to get your take on this day and, of course, this week with these dramatic moves. David Spica of Guidestone Capital Management. Really appreciate it.
Thank you.
We want to go back now to our breaking news with the SEC investigating Elon Musk over his 2022 purchases of Twitter stock. The SEC says Elon Musk failed to appear for testimony last month. Let's bring in right now Bloomberg's Tom Giles to give us some context here. And Tom, this is for a transaction that took place in 2022. Can you give us some more context here?
That's right. I mean, what's the development today is that the SEC wants Elon Musk to come in and testify. The agency is in the midst of a probe. We've gotten hints here and there about what the SEC is looking into, and I'll get to that in a second. But what this is about is SEC is saying that Musk was asked to come in to provide testimony in San Francisco last month, and that he failed to do that. And so what they're doing now is they're actually suing him in federal court to get him to testify. We've heard before about the SEC poking around Elon Musk's acquisition of Twitter, which, as you said, happened last year. The things that they're looking into, in particular, he tweeted back in May of that year about how the deal cannot move forward. This all came out in the middle of last year. It was basically the things that he said publicly about the deal. The SEC is wondering whether those things were on the up and up.
All right, Tom Giles there, of course, helps to lead our technology coverage here at Bloomberg. The latest news involving Elon Musk and the SEC going after him over that Twitter deal. Again, this seems to be a little bit more procedural with regards to him skipping out on a hearing that they, I guess, wanted him there for. No real market reaction there. As, of course, as we know, Twitter now private. And as far as Tesla investors, they don't really seem to be too bothered by this. Let's go back to the broader market now, Scarlett, with just about a minute left here until we get to the closing bells. We're pretty much unchanged on the day, and I think that's because everyone really wants to see those jobs numbers that we're going to get out tomorrow.
Yeah, although we were down pretty dramatically earlier in the session at one point with the Nasdaq off by more than 1%, but we've clawed our way back. There is some red on the screen. These are not big losses by any stretch of the imagination. And of course, the bond market, which has been really driving all the price action across asset classes, is mixed. You have yields on the shorter end down and yields on the longer end rising. The 10-year yield 4.71% today.
All right, the VIX slightly lower here on the day. So too is the dollar, and a big move that we're seeing right now in the energy space with WTI crude down another couple percentage points. That's after, of course, that 5% drop yesterday. So we're back down to $82 a barrel here. That's kind of the setup as we head into that jobs report tomorrow morning. With the market today, as you hear the bells in New York, relatively unchanged on the day. The Dow Jones Industrial Average down about 10 points, or a fraction of a percent. The S&P down about 5 or 6 points, down about 0.1%. The Nasdaq Composite is going to finish lower by 16 points, or 0.1% here on the day. Hey, and how about the Russell 2000, Scarlet Fu? Higher on the day, but by only about 0.1%.
Okay, so fairly modest moves. And I've been tracking the different industry groups in the S&P 500 all day long, and they've been moving around throughout the afternoon. So right now, when you look at it, it's a pretty mixed picture, although the decliners are certainly seeing bigger moves than the advancers. Let's start with the upside. You've got telecoms, insurance companies, and pharma companies up at least 0.5%. But on the downside, three groups losing at least 1%. Food, beverage, and tobacco, traditional havens, losing more than 3%. Household and personal products, also another defensive sector, losing 1.5%. And materials losing ground again by 1.3%.
All right. We look at the sectors there. I think we need to take a look at some of the individual movers. Jess Menton stopping by, gracing us here on the program. Of course, it helps lead our cross-asset coverage here on Bloomberg here. And let's talk about some of the names, because I was looking at the S&P 500, kind of half the stocks higher, half the stocks lower. Were there any ones that really stood out at you?
Well, taking a look and starting through some of the gainers here. So Lamb Weston, that's ticker symbol LW. If you look at that stock up, it is known for its frozen French fries, up 8%. So this is its best day since January 5th. 5th earlier
also make
this
like
year.
Hash browns.
They do.
Tater tots.
Potatoes.
It's just basically different iterations.
It definitely is. And one of those things, I don't know about you, Romaine, but I like French fries.
I'm a big fan.
I don't. Is there anyone in the world who doesn't like French fries?
I don't think so.
I don't think so.
I think Gwyneth Paltrow does not like French fries.
I mean, she should, but maybe if she had some of these, she'd change her mind. But you are seeing that stock among the biggest gainers here, and that really came after posting a 25% jump in volume during the latest quarter. So that EPS there topping expectations, and the company did boost its yearly earnings forecast there by 55 cents. Another one I wanted to point out, now this is a smaller company with a market cap less than $1 billion, but I had to point out Orchard Therapeutics, ORTX, ticker symbol up 96% today. So this is actually a US listed ADR here. So that is actually its best percentage gain on record there. So that does come.
This is acquisition?
Yes. So UK biopharmaceutical company here. So Japan's Kyowa Kirin actually agreed to acquire the company for $387 million or $16 per share when it comes to those American depository shares there. And then UWM Holdings, so that's UWMC, that is a mortgage finance company. It's up also about 8%, so best day since July 10th of this year. Now, actually, when you look at that, BTIG actually upgraded this company from buy to neutral. It does have a price target set to about $6. That would imply close to a 30% increase from yesterday's closing price. If you look at where it was at today, though, obviously closing around $5 per share. And then, of course, I'll bring up the decliners here. Rivian, obviously, whenever I hear with the EV makers, I think of Matt Miller.
23%. Well, Matt Miller's already gone home.
Of course.
I think on his like electric, Harley Davidson or something.
I'm sure he's test driving something right now.
Why is Rivian down 27%?
So 23% today. So looking at this biggest drop, actually, this looks like potentially the biggest drop on record here. So it actually announced a convertible debt plan. The company announced it's actually $1.5 billion in convertible notes there. Also, if you wanted to see another stock pressured, Lucid, worst performer in the NASDAQ 100, dropping as well. So it did launch a cheaper iteration of its Air electric luxury sedan there, but unfortunately not helping the stock. Not helping the stock. Car to begin with. It is.
So what is it, like just about like 150 grand?
Right. I mean, when you talk to some of these cars, especially that Matt drives, I mean,
does Matt have a Rivian? I actually finally saw Rivian for the first time when I was
He's been trying to get hold of a particular EV for some time now, and I think he still hasn't gotten it. So he's a little miffed by that. But I'll have to check in with him tomorrow.
Traditional car guy.
Yes. Clorox, CLX, so down 5%, worst day since November 2nd of last year. So as we know, consumer goods company, and it did unfortunately still reeling from that cyber attack that did disrupt that production there. So you are seeing the stock pretty pressured there.
The guidance that it gave, it was awful.
Preliminary net sales dropping by 23% to 28% in this past quarter.
It's just hard for me to fathom because it makes you, there's still a lot we don't know about the hack, right?
Right.
But it must have been so severe. How severe must it have been with that type of drop in guidance was warranted here? Their sales were affected that much by
They were, and they were actually expecting it to happen in the mid-single digits. So you're obviously seeing that in the double digits above 20% there. So that they really underestimated the impact
I
of
wonder
what
if
would
that
happen.
means that this had been happening for a while before anyone uncovered it. And
that's a good
to
point.
Go back and really dig through the numbers to see what was real, what was not.
Right, and that's a great point to see just how much clearly underestimating that and what that could mean moving forward. So clearly investors not liking that. And I wanted to lastly end when it comes to when we're thinking about beer, alcohol stocks, Constellation Brands, STR,
have we stopped
STZ
drinking?
rather. Apparently not when it comes to beer sales. So if you're looking at that, those rose about 12% for the prior year. So actually that was driven a lot by none other than Modelo. But unfortunately, wine and spirits unit continues to struggle there. Wells Fargo pointing out that even though some of those beer sales were elevated there, yes, apparently people aren't drinking wine and spirits as much as beer right now.
And Modelo wins out.
Football season, maybe? Come on.
Football, but beer doesn't do anything for you.
Oh, you like the gin, right? I feel like that happened to us one time. We were talking about the wine segments with Carol.
No comment from Romaine.
Carol Master. I remember that now when we were on.
Just drink tea. Tea just meant.
There you go.
But there you go. You're looking at that stock down about 3%. Worst day since January 5th there.
That was a nice wrap up there. I'm just going to add one, and this is actually an after hours trading here. AMC shares getting a little bit of a pop And do you want to know why, Jess Menton?
Please tell me.
Taylor Swift. Oh my gosh, I knew it. Even before
concert
you said
film
it.
sales have already crossed the $100 million mark in advanced sales. That's the headline crossing the wire right now, Scarlet Fu.
They're making hay on this.
I guess I should never doubt the power of Taylor Swift on our economy.
We can't.
But I mean,
all the
this is
sportscasters
insane.
are realizing the power of Taylor Swift.
Yeah.
Yeah, because every single time there's a football game on Sunday, they have to keep talking about her being in the stands.
Got to get ready this weekend.
Yeah, exactly.
Good grief. Jess Menton, great to catch up with you. Goodbye.
Always a pleasure.
Sure thing.
Come back.
Scarlett and Fu and I are still here.
This is what happens when radio doesn't join us. My gosh.
Scarlett, I don't, want to belabor this point here, and I do want to go back to the yield space, right?
Yep.
And obviously not a whole lot of action today. But when we talk about the velocity of change and the rate of change, that really seems to be spooking investors. And we saw our previous guest kind of mention that idea, right? It's not just the level, but it's also just all the volatility in between.
And the nuances within, right?
Yeah.
Because right now we're seeing long-term yields move faster than short-term yields. And that's the reverse of what we had when the Fed began raising rates in 2022. So there's definitely a different flavor to what we're seeing in this, I guess you could call it a bit of a tantrum. And it all drives what happens across other asset classes like equities.
Yeah, absolutely. And the correlations that we've been seeing now, I mean, quite insane. I mean, obviously the negative correlation between yields and, of course, equity prices, but then the correlations you're seeing with the dollar as well as with the
That's a really
commodity
good point.
space. It's an interesting setup here heading into, of course, the next data point tomorrow. And then, of course, that takes us into earnings season.
And don't forget CPI as well next week.
Next week, of course. Before we get there, we have a lot to talk about. And, oh, gosh, what's going on Congress? Capitol Hill, still in limbo. Kevin McCarthy out as Speaker of the House. We know that. The big question is who's going to replace him? And God, great picture there. I guess the other question, though, is how soon are we going to find out? That conversation coming up next. This is Bloomberg. The yield story has been the main story in the cross-asset space here all week long. In fact, really for the last couple of months here. And I want you to take a look at the chart behind me, the divergence that you're seeing between the S&P 500 equities here, and more importantly, what we're seeing in real yields. Of course, you factor in inflation, and you go from where we were talking about almost 5% on that 10-year note, take us down to about 2.4. But it's that uptick that we've been seeing in real yields that has caused a lot of people concern. And I would also like to point out here, it's kind of hard to see on the chart, but the difference in change that we've seen over such a short period of time has really been a big part of the reason why you've seen so many people spooked in the equity market. That's had an outsized effect on how people revalue what's going on out there, including in some of the high valuation names that we've been seeing in the Philadelphia Semiconductor Index, down 0.5% on the day, and in correction territory, we should point out, down from the highs of the year. Utilities and other rate-sensitive sectors also getting batted around. That sector as a group down 0.7% on the day. And if you're looking for any sort of light out of the cyclical sector, that trade just really has not been able to get any traction. We saw a little bit of activity last week in the Russell 2000 and the Dow Transports, but that's being pulled back here on this week. Pharmaceuticals and healthcare, one of the few bright spots here on the day. But the bigger question right now has to go with some of the inflation metrics here, what the Fed is looking for. We know the jobs report, we know the wage data. That's all going to be a big factor in this, but so too is what we're seeing in the commodity space. Just a couple of weeks ago, we were talking about $100 a barrel oil and how that could actually disrupt the Fed's trajectory of what it had planned to do, or maybe what it planned not to do here. Since then, you've seen a big drawdown in that space right now. Over the last 2 days alone, just a 7% drop in WTI crude that's taken us from those $95 a barrel level down to around $82, $83 a barrel here. The question is whether this is the start of a new downtrend or simply a hiccup in what had been the new uptrend here. One big data point to keep an eye on here, Scarlet Fu, as we try to assess macroeconomic conditions.
Yeah, and every time gas prices go up, policymakers hear about it. And speaking of policymakers, where are they and what are they doing? The question in Washington is work in Congress has ground to a big halt as Republicans are searching for a new speaker. It's threatening Ukraine aid and, of course, delaying consequential legislation, including the need to refund or to fund our government past November 15th. Bloomberg's Kelly Lyons is here now to fill us all in. Kelly, is there anything happening on Capitol Hill? It sounds like members of Congress have gone home and are in recess.
Yeah, it's very quiet on Capitol Hill right now. Technically, neither the House or Senate is in session. The House won't be back until Tuesday. And frankly, even if they were in session, if there's no new speaker, they couldn't be getting anything legislative done anyway. The Speaker pro tempore, Congressman Patrick McHenry of North Carolina, has limited power in that interim position. Granted, it's kind of unprecedented. Nobody has ever been in his position before, but the thinking is that he can't proceed over normal legislative business of the House of Representatives, like importantly passing those appropriation bills or a Ukraine supplemental or anything else, really. What he can preside over is the actual election of the Speaker, and that is what we are expecting next week. As I said, members will come back on Tuesday, and on Tuesday, we do expect the Republican conference will be holding a closed-door quorum in which they will be hearing from the candidates for Speaker. We just saw them on the screen there. Really, the two frontrunners at this point are Steve Scalise, the number 2 Republican, longtime leadership member in the House, and then, of course, Jim Jordan, who chairs the Judiciary Committee, is more aligned with the harder right flank of the Republican Party. It's just a question now of if either of them or anyone else can get the majority votes that they need.
I'm curious here. I mean, we talk about sort of who is leading this party, and there was some interesting reporting by your colleagues down in Washington that the former president, Donald Trump, might actually try to make an appearance at this meeting on Tuesday.
Yeah, that's what we're learning, and a couple other outlets have reported this as well. And remember, Donald Trump actually appeared on some ballots for Speaker back in January when Kevin McCarthy was going 15 rounds to try to get the gavel. There have been some murmurs once McCarthy was ousted that, could Donald Trump be Speaker? He technically can't because the Republican conference rules say that anyone who is under serious indictment cannot be Speaker of the House. But he could still put his thumb on the scale. This is where you could really see the former president's remaining influence on the Republican Party showing up, especially knowing that he's pretty closely allied with Jim Jordan, who is one of the leading candidates here for Speaker. So it's kind of anyone's guess what is actually going to happen. But we could be looking at a protracted fight here, whether or not former President Trump decides to endorse any one candidate. We're going to have to wait and see the outcome of all of this next week.
All right, Kayleigh Lyons, doing such great work. Throw your hat in the ring there for speakership here. I would vote for you. Of course, you can check out Kayleigh every day right after this program, 5 p.m. Washington time on Balance of Power. Stick with us here on The Close. We'll be back in a moment with more coverage. This is Bloomberg. All right, the Treasury market has been all the rage these days, at least if you're in the selling mood, with the 10-year yield rising more than half a percentage point in the past month alone, surpassing the 4.7 mark, which apparently heightens the danger in the near term of a financial blowup. Liz McCormick joining us right now, who helps to cover this for us here at Bloomberg. And I am curious, Liz, as to what you make of some of the price action, particularly at the longer end of the curve here, right? I mean, we know that this has been a sell-off, but the question is, why are we seeing that sell-off?
That seems to be the million-dollar question, right? And everyone's talking about a mix of things, which I think it is. I think it's the market is, remember the last Fed meeting, they recalibrated their dots. So that kind of showed higher for longer. Market kind of bought that finally. Then we have this, I was looking at Evercore ISI had a note, the net higher for longer supply forever, So we have the fiscal situation where we have this deficit that keeps growing and we have more supply coming for the next several quarters, people predict. And then, term premium, this wonky thing that I've always liked to write about, that, investors are finally saying we really need to be compensated for the mix of risks of buying long-term bonds, putting our money with the Treasury Department 10, 20 years. So you've seen that break to positive levels for the first time since like 2021. So I think it's all, and like some technical stuff. Yeah. I think you see shorts keep getting blown out. There's people hedging now, like 5% yields, so it's all kind of working together. And I don't think it's all just on the economy. It's been pretty good. But
how much did positioning play then?
Yeah, I think it played a role.
Yeah.
So we've got more supply. There's a 2-year, 10-year, and 30-year auction next week coming up. Talk about the demand part of it, because weakening demand from overseas buyers, particularly Japan and China, has become this narrative that everyone brings up. But do the numbers really bear that out?
They do. They definitely do. And I think that's a big topic. It's not the supply juxtaposed against a demand that Treasury always sells their securities. But you've got more price-sensitive buyers. It's the hedge funds, the U.S. asset managers that have really been picking up the slack over recent years. And they think that's going to continue to be the factor because there's rate rates better abroad, right? So, it's not the only game in town to invest in U.S. Treasuries and get a good yield. Banks are losing money on Treasuries, so they're selling them. A lot of people holding Treasuries are underwater. So people think it's going to be hedge funds, asset managers who will buy, but they'll demand a better price, so higher yield.
Well, and at least for right now, they're getting that. I guess the question is, when we talk about sort of whether people are willing to extend the duration, assuming that they do actually get a little bit more of a premium here, is that going to be enough to really arrest the sell-off in general? Because we've actually seen buying in this space. I mean, we call it a sell-off, and it has been. But we've also seen, when you look at the price action, clearly some people have said, OK, wherever we are right now, 4.6, 4.7, that's good enough for us.
Yeah, I think, remember we talked probably months ago where people were saying, 4.25, that's good. And then you can't go above 4.5. So now that it's gone all the way above that 10 years, I think people are afraid. I don't think it's just going to be this wave of demand. I think something has to break this, whether we have jobs tomorrow.
Yeah.
I mean, the whisper number is stronger, but, if the labor market starts to really crack and people feel like, inflation, we have CPI and PPI next week, right? So if the data moves or something breaks, like we see another issue with financial security, with the banking system or something like that. We'll see,
There's a lot to see. And of course, there are a lot of data points to key off of. Liz McCormick, thank you so much for joining us. Bloomberg's Liz McCormick, of course, our correspondent for all things macro and especially our go-to expert on the bond market. Let's continue the conversation on the action in the bond market from Andrea DiCenso. She is portfolio manager at Loomis Sayles, specializing in this asset class. Andrea, thank you so much for joining us. If you could start us off by comparing and contrasting the move up that we're seeing in Treasury yields this month versus when the Fed first began raising rates back in 2022, because right now we're seeing the longer end of the yield curve move up faster than the shorter end, whereas back then it was the shorter end. What does that signal to you?
Sure. When you think about, clear recessionary indicators, for us, seeing that bear steepening is one of the indicators that we are getting even closer to a recession. Of course, inversion of 2s10s is always another indicator that's been quoted time over time. But to see that term premium that Liz was just reflecting on, whether it be driven by Treasury supply that's coming to market or just concerns about inflation expectations not rolling over as quickly as perhaps some of the data has already suggested and being stickier than what we think right now, we think that term premium that's being required by the overall investor in the marketplace is what could roll over and end up breaking down the consumer, which has held up our economy really quite well over the last 18 months.
So we talked about the reasons behind what's driving the sell-off in Treasuries, and we talked about increased supply. We're going to get a lot of extra supply next week. How much of the poor price action do you think we'll continue to see with the Treasury auctions taking place? Is that going to really reveal how much of a factor increased supply is as a driver?
I think so. I think tomorrow's print also on jobs is going to be key because, again, our economy is really being well supported by two things: a tight labor market and the consumer at this point. So if we see either of those begin to show signs of weakness, that this tighter monetary condition is really starting to bite the consumer, that's going to be the number one indicator to us that perhaps more term premium needs to be priced into the market, and you could see that yield continue to rise and perhaps less demand.
I am curious about the differentials that we're seeing in the yield space and whether that's playing a little bit of a factor in the sell-off here, because we talk about a benchmark at 4.7, but we're really not much different here, whether you're looking at a 2-year, 5-year, 30-year, or something in between. And I'd be remiss in not pointing out that, there are savings accounts out there, short and long-term savings accounts, where you can basically get 4.5% here. What is the competition like for yield?
Sure. I think now when we're thinking about competition for yield, it's about, do you want to lock in these rates right now, and for what amount of time are you willing to lock that in? I think maybe 12 months ago, that money market yield was really attractive, and you didn't mind having your money be locked up for whether it be 3, 6, or 9 months, because you still believed that there were further opportunities to reinvest that money in a future, perhaps better rate. However, now we're beginning to wonder, how much longer can these tighter financial and monetary conditions really uphold this hiking cycle that we've seen play out? Should we be increasing our concern of pivoting to perhaps staying higher for longer and then seeing the consumer roll over, which will inevitably lead to a rate cutting cycle? So the opportunities that we're finding in, say, some BBB corporates at this point are really attractive. Rate volatility just went through that market like a wrecking ball. And at this point, we think we are closer to the end of seeing higher rates near term than we are to the beginning of that.
When you say closer to the end, does that mean an end of the increase, or do you actually think we're going to see a material drop in those rates?
I think we start to see buyers step in. You saw it just earlier this week, right? I mean, there's no magic number. Rates are absolutely going to overshoot, especially when you have this stagflationary regime that we're in right now. But as rates do jump over 5, it's been met with buying. And I think that's the important key point to watch is, are you seeing those buyers actually willing to step in at levels above 5? A lot of calls out on the street going anywhere from 5, 6, even 7% in rates. I think you really need to have a stable consumer to see that play out. And you're already seeing the consumer excess savings rolling over pretty dramatically, not just in the US, more severe in Europe and within emerging markets.
Yeah. When we talk about higher for longer, that's leading to more bets on a stronger dollar as well. So the US dollar getting a boost versus other currencies, but I wonder what that means for other assets like treasuries, like equities.
I mean, I think it goes without saying that rates being up here, especially real rates being up here, you can call into question whether PE multiples make sense at this point at their current level. Certainly the dollar is just following the path of rates. So we've seen a lot of, short dollar positioning reverse as you got that 6.5% increase in the DXY relative to other currencies. The question is, where do we go from here? And are we going to see another rate hike this year that could cause further increases in the dollar? I think, Fed President out of San Francisco Daily cited today, the bond market may have taken care of that a little bit for the Fed and pushed out the possibility of them needing to hike again.
All right, Andrea, we're going to have to leave it there. Great insights. Andrea DiCenso, their portfolio manager over at Loomis. Sayles. That quote by Mary Daly really is key. The setup into a U.S. jobs report tomorrow. Our focus for the next 30 minutes is on the U.S. labor market. Stick with us. This is The Close on Bloomberg. A somewhat muted day on Wall Street, though it was not without a bit of volatility. You take a look at the equity space here, relatively unchanged for the Dow, the S&P, and the NASDAQ. The Russell really the only one of the major indices to post any sort of gain here on the day. The VIX did get tamped down a little bit here on the day. So too did the dollar, and actually so too in a big way did WTI crude. In fact, down for a second day, a 7% drop just in the last 2 days alone, a far cry from just, a week and a half ago when we were all talking about the potential for $100 a barrel on oil. A big part of the reason for, I guess, the somewhat slump that we've been seeing as of late has everything to do with Treasury yields that continue to drift higher. While that drift higher, that sell-off, if you will, in price, that uptick in yields was put on pause just for a little bit today. That could change dramatically in just a few hours. 8:30 a.m. Washington time, Scarlett. We're going to get that monthly jobs report that I think the whole market has been waiting on.
Absolutely. And of course, that 8:30 a.m. report will play a big part in informing the Fed's decision on November 1st as well. And that is the payrolls report for the month of September. Here now to give us a preview of what the consensus is right now is our Abigail Doolittle. Abigail?
Well, Scarlett, it seems as though investors, traders, forecasters, economists are really looking for what I would consider to be a little bit of a Goldilocks report, because the number that is estimated by a survey of economists from Bloomberg is looking for 170,000 jobs added in the month of September. That's down slightly from 187,000 jobs in the month of August, but basically in line. I would say anything below 200, between 150 and 200, will probably be seen as in line and not too much of a reaction from markets. Above 200, then you could have a scenario where yields shoot higher. Good news is bad news. below 150. Maybe it could be the opposite. But of course, folks will also be looking at the unemployment rate. The average hourly earnings estimates expected to stay at 4.3%. But some of those details as well beneath the surface. But again, on the surface, it looks kind of benign. One interesting picture, though, that's emerging over the course of the last year is the fact that payrolls, with the exception of some real strength in the wintertime, have basically been declining a little bit over the last few months. So the hot job market, it seems as though the Fed's raising rates has really helped out there. On the other hand, if we dig into the unemployment rate, what we're looking at here in blue is the unemployment rate, so above 14% at the pandemic peak. In white, this is the Fed forecast for the September meeting that we just came out. You can see that the numbers are basically matching. The unemployment rate for the month of September, I think it's expected to decline just a little bit more. So that's one aspect of the job report that would suggest that maybe the Fed will have more work. But of course, everybody's going to be watching this because it will be a key data point for the Fed and that all-important November FOMC meeting.
A great setup there from Abigail Doolittle. Let's get some insights out of Jennifer Lee, BMO Capital Markets Senior Economist and Managing Director, joining us right now. And Jennifer, Abigail was just walking us through the number, and I do want to start with that headline number, 170,000 jobs created. And I was just taking a look here. That would actually put us back down at around the historical averages, at least prior to the COVID pandemic here. And so I'm wondering that, I mean, we make all this hay about the slowdown in the job market, but I'm wondering if we just kind of course corrected back to whatever the old normal was.
What we're seeing is, first of all, good afternoon. Thanks for having me on. I'm having heart palpitations, getting ready for tomorrow. So we're looking about 170,000 or so, 175,000 in line with consensus. And yes, that is down from the average over the past year. But this is the expected cooling in the labor market that we have been expecting after, over 500 basis points of tightening. Things are finally starting to cool down. And whether or not it's going to be that Goldilocks report that, that some people are talking about, I don't know about that. This can be pretty wonky. And there's going to be some noise, I think, involved with this report. So we sort of have to take everything with a grain of salt. But certainly the headline is going to have the big impact, what the unemployment rate does, and definitely average hourly earnings as well.
Yeah, and at least based on economists' forecasts when it comes to the wages as well as that unemployment rate, I don't really see a disinflation story there just yet. I am curious, Jennifer, I mean, what do you really want to see out of this report? Not necessarily just this one report, but I guess all of these labor market data points that we've been getting here. What do you want to see that would give you a little bit more comfort, not just into the stability of the job market, but also the idea that we are seeing enough disinflation that the Fed might actually be, at some point soon, be willing to say mission accomplished?
I would like to see a steady slowdown, I guess, in average hourly earnings, because that's where a lot of this oomph is going to come for the consumer. And if we see too much of heated wage increases, that's going to cause the Fed to be a lot more worried. But at the same time, on the one hand, on the other hand, saying, you want the consumer to have a good job, a steady income, and that will help cushion their savings and create a more healthier balance sheet, of course, but not too much that we're going to be too inflationary. So what I want to see is steadier wage growth, and perhaps a consumer that's going to pull back a little bit in this still tight or high inflationary environment, and enough for the economy to start cooling a little bit more, and for the Fed to sort of give up a lot of more of its hawkish rhetoric that we've been hearing still over the past week.
Of course, Jennifer, we can't ignore the backdrop of what's happening, this summer of strikes that we've all spent a lot of time talking about. How will the recent work stoppages show up in these September numbers? Or if they don't, how much noise will they bring to future economic reports, like the October jobs numbers?
So that's a great question. So this is why we should always take these reports with a grain of salt. There's always going to be something that's going to be impacting it, and there are going to be revisions, of course. So the UAW strike, I think because they're striking workers, they're still being paid, so they're not going to be counted. But at the same time, aggregate hours worked will be impacted. So we're going to see probably a little bit of a weaker number on that front after the big 0.4% jump in August. Overall, by the way, Q3 is looking still pretty decent for the overall economy. But as well, we're going to probably see some of this play out later. Again, depending on how long these strikes last for. The UAW is the big one. Of course, we also heard about what's happening in California, with possibly in Vegas, where we have all these hotel workers are potentially going to be walking out as well. And of course, the biggest strike for the U.S. health industry with Kaiser, with 75,000 people walking out as well. So that's probably going to be impacting the October jobs report, again, depending on how long these strikes last for. So you sort of have to take it with a grain of salt. It's not going to last forever, hopefully, and things will bounce back. back. But overall, again, we want to see that gradual slowdown in employment growth.
Yeah, but important to note that the October jobs report won't come out in time for the FOMC meeting on November 1st. So tomorrow's report will be the last one that the Fed sees. And also keeping up with just what's happening right now, we've seen this incredible move in bond yields. Does increased volatility in bond yields have a material impact on economic data? I mean, if the 10-year yield gets to 5% and stays above that level, does it matter how rocky the path was to get to that level, or is it just, does that have any bearing on the data in any way from where you sit?
I think, well, again, it's going to depend on how long it's going to stay there for, because, even just today, by the end of the day, I saw all this green on my screen when I hit WD on Bloomberg. So again, depending how long it's going to stay for and how long that volatility is going to last, but the more tight these financial conditions are going to become, as your previous guest was talking about, that is also going to sort of pull back economic activity, and we're going to see that slowdown that we have been waiting for. How much of a slowdown, that's going to depend on all the data, on all the hiring that's going on, all the wage increases, and of course how interest rates and equity markets are playing out. But the more volatile things are, the more nervous people get, and they might start to pull back a little bit.
Are you confident, or do you at least have enough conviction here that we can at least avoid a recession? And if so, why?
That is still our base case scenario, is that softish landing. But of course, the more volatile these markets have been, especially over the past week, and thankfully, we saw oil prices pull back over the past couple of days. That will certainly help. But, I think it goes back to the U.S. consumer. As long as they have a steady job, a steady income, and I think that is what is critical. Whether or not they're going to keep spending is another story. Hopefully they don't, and that's okay, as long as they have some money put away on the side or put aside for a rainy day. And that will be, I think, the foundation, of a more solid overall U.S. economy.
So just looking past tomorrow's jobs report, next week we've got CPI, we've got the FOMC minutes, we've also got a bunch of Treasury auctions. Of those three events, which could surprise the markets, surprise your clients the most?
CPI. It's going to have to be CPI. I think that's the one thing that is, like you pointed out earlier, payrolls. This is going to be the last jobs report before the November 1st decision. Then we're going to get CPI, and after that, towards the end of the month, we're going to have the PCE report. So I think CPI is going to be the big one before, again, towards the end of the month.
All right, Jennifer, great to catch up with you. Jennifer Lee there over at BMO Capital Markets. Here, a preview of that jobs report tomorrow, 170K. That's what economists on average are expecting, with the unemployment rate expected to tick down and wages expected to tick up. Coming up, we're going to continue our focus on the job market and a focus on inequality and the true rate of unemployment. Our next guest has some thoughts here about how to better measure labor market conditions. Gene Ludwig, the founder and CEO of Ludwig Advisors and the former U.S. Comptroller of the Currency. He's coming up next. This is Bloomberg. A focus on a big U.S. jobs report scheduled for tomorrow morning, and a focus on the unemployment rate. A headline number right now at 3.8%. A headline number expected to go down to 3.7% when we get the latest data tomorrow. But according to the Ludwig Institute, the true rate of unemployment is a lot higher, as much as 23%. That includes people who are working part-time and seeking full-time jobs, or working a job that pays less than poverty wages, defined as $20,000 a year. Joining us right now is Gene Ludwig. He's the founder and CEO of Ludwig Advisors. He's also a former U.S. Comptroller of the Currency and has had a long career in Washington and on Wall Street. Great to have you here, Gene.
Great to be here, Romaine.
I do want to talk about kind of the disconnect between the official data, which shows a pretty strong labor market, unemployment rate near record lows here, and a lot of anecdotal evidence that seems to suggest there is a huge swath of our population right now that is still struggling.
Romaine, I honor your really focusing on this important topic, because the headline statistics are horribly misleading, not just for ordinary Americans, but importantly, they're misleading for our policymakers. The fact of the matter is, if you filter that unemployment data that's going to come out tomorrow for people who want a full-time job but can't get it, maybe only working an hour or two, every 2 weeks, and filter it for people who can't earn above a poverty wage, that's $20,000 a year. You can't live on that. If you filter it, then you're up to 23%. And that is more reflective of reality and the struggle middle and low income Americans are having today.
I mean, I'm glad that you and your institute are trying to sort of get a better handle and actually put hard data to, I think, what we kind of all know is true, but maybe aren't able to quantify it. And I want to go back to when the government, the U.S. government, started to try to track some of the stuff. Remember, they introduced the underemployment rate and a few other metrics to try to capture some of that nuance. And we should point out the difference between the underemployment rate and the actual unemployment rate. It's significant, but that's still nowhere near the 23% that you have. I think the underemployment rate's like 7%.
Right. Look, that's very astute. The fact is that these definitions started to emerge in the 1870s, 1880s, when we began to think about statistics and how the importance they would be to be tracked for the economy. It was in the 1930s that the current definitions were locked in stone. But that's been a long time, and there's been many changes in the society, right? Full-time employment, which was common then. You went to a union job in the factory, you either had it or you didn't have it. That's all changed. We're living in a gig economy. And so while that's changed, unfortunately, the definitions haven't changed. And we've got a mess because we're misleading our policymakers, and that leads to bad policy.
So your take is your true unemployment rate is a better reflection, more accurate reflection of what's happening around the country. How far back does this data go? Does it go back to the 1930s, for instance, the 1950s? I mean, I'm wondering what kind of story it tells if you go back decades.
We've tracked since 2020, pretty much. I mean, actually, excuse me. We go back to really 2000 in terms of how we track forward, because the data is more accurate for us, given that swath. But the problem, I think, begins to emerge after the Reagan administration. It's just that the data isn't sufficiently robust, so you can be sure of what you're doing. From 2000 on, it's pretty robust, and we're pretty confident of the last 20 years.
You talk about how you want to give policymakers a more true and accurate picture of what's actually happening, something that's not as misleading. So who's using your true unemployment rate right now, and how are they using it?
Well, what I think is really great is more and more we're seeing op-eds, policymakers, others on both sides of the aisle. The interesting thing is this is something that we have not had criticism from the left, from the right. Policymakers have really begun to focus on this data. But what you're doing on this show is so important, which is to getting the word out. People may have a slightly different take on this in terms of what reality is, but what we've got in these headline statistics is not reality. And, you know, it was really interesting. The chairman of the Fed visited my hometown in the last several days, York, Pennsylvania.
I saw that.
I got all excited because Amish country is where I grew up. And he began to ask questions about how are people living. And I encourage everybody to read that interview. People recognize how bad it is for them. Life is not, jolly for middle and low income Americans. It's a struggle. Some people characterize it as the hanging on by your fingernails generation. But it is not good. We've got to face up to it. We've got to make changes.
But do you think that Powell, and for that matter, the Fed as a whole, is trying to make a better effort at this? Remember when he took over, or at least maybe a year or so after, he started those Fed Listens tours, and even the tour that he did in York, Pennsylvania, seems to be part of sort of this broader initiative to try to understand the economy outside of just the data alone here. What kind of fruit do you think, if at all, will be born from this effort?
Well, I have a lot of respect for the Fed, and I have a lot of respect for the chairman. And I think tours like this, going out and actually seeing it, feeling and touching it, which is how I got started with this. I grew up in this town, and things were supposed to be rosy when I started looking seriously at this. Close to a decade or more ago, and things weren't rosy. Things were declining. They weren't going up. And so his going out is terrific.
Well, this gets to another data point that your institute has put out called the True Cost of Living Index. And we've had this discussion on the program. We know the Fed backs out a lot of the things that, quite frankly, make up a big bulk of our costs, primarily because they say we can't control it, right? They don't really have much control over food prices and energy prices, so why factor that in? But some of the metrics that you're looking at are taken into account by the Fed. And despite the fact that we have a lot of evidence that those costs not only are high, but have remained high and not come down despite the disinflation in the headline number here. How do you reconcile that?
Well, the government has got to bite the bullet and change these definitions. CPI is not an accurate reflection for middle and low income Americans of inflation, what they're feeling. The true rate of the true cost of living index, which we've created, is much, much better. Why? Because the CPI is a basket of 80,000 goods. But for middle and low income Americans, it's a very small basket of what they're able to afford, keeping them alive. It's food, it's housing, it's transportation. If you look at that basket of goods, it's inflated more rapidly. Again, using my 2000 to today, you see in CPI going up 50%, but the true cost of living is up 75%. So for middle and low income Americans, that's a big difference. And of course, that goes into what your Social Security is and whether it goes up and other government programs and how they affect you. This is a big deal.
So you've tracked this long enough to see trends. Are there any improvements in either the cost of living or in the true unemployment rate that you can share with us?
Well, I'm happy to say, in terms of the true, things have gotten a little bit better over the last couple of years. But this is a long-term trend. It's going to take a considerable time to turn this around. As we were talking earlier, Katie, this is something we have got to focus on as a nation, because we have angry people, justifiably angry, being told things are rosy when in fact they know things are not rosy.
All right. Well, a sobering look here, and maybe one day our politicians and regulators will get around to actually taking a sobering look at what the real economy looks like. Gene Ludwig, great to have you here in studio. He's the founder and CEO of Ludwig Advisors and a former comptroller of the currency. Stick with us here on The Close. We're going to set you up for a big day on Friday and what financial markets are going to have their eye on. This is Bloomberg. A busy day here on this Thursday. Here's what financial markets will have their eye on Friday, and it's one big thing, U.S. jobs report.
That's right. What we're looking for is 170,000 jobs added in the month of September. But that's a slowdown from the prior month, but also for the unemployment rate to tick somewhat lower to 3.7%.
Yeah, lower 3.7% and average hourly earnings up. That doesn't look like disinflation to me. We are going to hear from the Labor Secretary tomorrow as well, Julie Su.
Julie Su coming on after the market opens, giving us some perspective on what they see going ahead and how they're going to frame this strong labor market.
Fed speak from Waller tomorrow. I'm sure you'll be wrapped by that.
Oh, yeah, always. One Fed speaker after 5 today.
And guess what? Just to mix things up, a satellite launch. Amazon poised to launch the first 2 test satellites from Cape Canaveral, Scarlett.
Get excited.
Who you got? This is Bloomberg.